Okay. And I will call the meeting to order. And let's go on to item B, establishment of a quorum.
Excuse me. Director Covington? Here. Vice President Vella?
Here.
President Wheeler?
Here. Okay. Pledge of allegiance. Brendan, you want to do it?
Sure.
Yeah.
Everybody face the flag, put your right hand over your heart. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Do we have any public comments?
No comments.
Good. Agenda review, are there any additions or deletions or changes to the consent agenda?
No, good.
Okay. Then going on to acknowledgements and presentations, we have none. Good. And the consent agenda. We have units and expenditures. Any questions on those?
No. I'll move to approve the consent.
Yeah.
Seconded, okay. We just vote on that?
Yeah.
All those in favor?
Aye.
Aye. Thank you. And hearings and appeals, item 6, we have none. And item 7, capital improvements program.
All right.
So tonight we'll receive an update on the Folger Drive project. It's been a while since we brought this to the full board, but the project has been underway. So you know the history, and I did give Director Covington a bit more backstory and history on kind of how we got here, but as part of evaluating after the flood at Dairy Lane, it was identified that the district would really benefit from establishing an emergency operations center, and we're very fortunate to have the Folger Drive property already, which, is well suited for this purpose. So we're working on, the updates to that property for purposes as an emergency operations center, as well as satellite courtyard, and really making the best use of the property. So we have Tom Beal, our architect from Nolan Tam, here, and a presentation prepared, but this is really, informational to talk about the scope, where we are in the process with the city, for you to ask any questions and give whatever feedback as we are at this stage. So you want to start with the presentation, Tom?
Sure. All right. I feel like I should point a little bit here, but for those of you who are not familiar with the site in the middle, oh, yeah.
The teacher.
Hello. So Folger Drive site, Notre Dame below, the existing office building. We're proposing a new prefabricated metal building. Some site and landscape improvements. And this is a image of the prefabricated metal building, the existing stucco building. Let's see, yeah, interior remodel. A lot of work on the bottom floor, which is basically a garage now. Making kind of residential portions, a kitchen, and the 2 floors here will be open offices stacked above for various uses, including board meetings in the future while the work at Dairy Lane will be done. Yeah, about 1,500 square feet. This is about 3,200 square feet. A new crane in the storage building, native plantings. I think that's the high points.
Yeah, and go through in a little bit more detail from the scope items.
And Kat, spoke to this a little bit. Support Dairy Lane while that work is being done, a new bunk space, shop spaces, uses an EOC, and then, some equipment storage, satellite corporation yard. Go to the next one. Kat, you want to talk about this one, the history of Folger Drive?
Sure, so we haven't been, dug up the records of exactly when the district purchased the property. But we did pull aerial photos, so going back to at least 1946, it was district property, used to have a tank. On site as well as a pump station. And, later evolved actually into part of the district headquarters in, the building was built in the 80s. If you recall, we actually also owned the property across the street, 1513 Folger, and so combined those two properties were district headquarters until we outgrew that space and purchased Dairy Lane. Also being a residential neighborhood, the neighbors didn't love our construction activities and whatnot and truck traffic in the neighborhood. So that was, I think, part of the decision process, but the district has since sold the 1513 property across the street, but retained this. And, most recently it's been used primarily for storage. And otherwise not particularly utilized.
So 1946 is the furthest back to go.
It's the furthest aerial photo that we have, and also the topos, some of them identify the tank on it, so we've had it at least 80 years.
I won't be surprised if that property was owned by either of the two agencies that merged before 1929.
Yeah, we probably have owned it longer,
Before
but
that, yeah,
try to dig up the records.
because obviously it was always earmarked as a high point at the time
Right.
for the tank,
Yeah, and the slightly frustrating thing that even though the district has owned it for so long, when the city did the general plan update, they rezoned it as residential. So that's part of our project, is getting it rezoned for our use.
Yeah, coming up, we'll have a zoning hearing where they'll change the zoning. They'll also do a design review as part of that meeting. And then once we're through with that hurdle, we go to the city council for approval. Our understanding is that the city council will be, on the consent calendar.
yeah.
And we're not, and the planners aren't anticipating any pushback along the way, but it's just process we have to follow.
Correct, but from the city standpoint, though, what else could it be zoned in that area?
Zoned residential.
Yeah, but there's no other way you could zone it.
Oh, they could have zoned it,
Governmental.
public, PS, public service, I think is
Public
what most of our
Public.
tank sites are all in residential areas and they're all zoned public.
Yeah,
Yes.
but you have like 80% of the whole area is residential, right?
Yes,
It's all residential,
Yeah.
except for no.
as long as they make the exception for us.
Yeah,
We're
well,
fine.
I mean, they kind of admitted it was a bit of a hoax, who knows what the coordination between the district, and the city was at that time, but. They kind of admitted they pulled back the records, they didn't find any records, they actually consulted with the district, they just made an assumption that we were gonna sell the property and zone it residential, so. Yeah, it is what it is, it's where we are, we gotta follow the process, they're very supportive of doing the rezoning, of course. It was either rezoning or doing, conditional use permit with all kinds of waivers for, the square footage ratios that they have to do, so. It makes a lot more sense, and then we don't have to, if we ever have to make any other modifications to the site, we don't have to jump through those hoops again, because it'll be zoned for our use.
Good.
We also have to do the same thing for Dairy Lane, by the way.
That's all residential.
No, it's zone service commercial that does not allow for government use.
Oh.
So now we have to get that rezoned for government use.
Has that been true the entire time the district has used Dairy Lane, or is that a new change that they've made?
I believe, they told us they rezoned that whole area and changed some of their zoning classifications for commercial type uses. When they did the general plan update a handful of years ago. So we had already been occupying it. Our use obviously is grandfathered in, so we're fine to be there, but doing, the updates that we want to do to Dairy Lane, we also need to rezone that property. So we're starting the rezoning process on that now, sooner rather than later.
Mhm.
So an aerial view of the site, PGD has an easement that goes through onto the Notre Dame property. existing building here with the tile roof, the old tank site where we're putting the metal building. We're keeping kind of all the parking configuration, redoing it a little bit in this area where the metal building is going. 2 trailers that are on the Dairy Lane site now are gonna be located here, so there's a little fussing around in this area. We're also, I don't know how much we want to get into this, but we had been talking to Notre Dame about making or reestablishing the connection that was here.
Mhm.
So that's not happening, but we are, because we're having to adjust the grades for entrance into the metal building. We're gonna go ahead and make grading changes here that in the future, if this connection ever wanted to happen, we'd be prepared for it.
Yeah, so the story with that, so we were talking actually to Stanford, who was likely planning to buy the property until their very recent decision that they weren't going to. And part of the thing is for the campus itself, there's only one entrance and exit. And so for their own, whoever owns the campus, I mean, for their own purposes, they do need to establish a second emergency vehicle access route. And so this,
Yeah, right.
for us, it's a very nice to have feature to have emergency vehicle access through that part of the property, and there had been access years ago there, but for whoever does purchase the campus in the future, it will be a requirement for them. And if you look at the neighborhood, we're really the easiest route as it is, so I think, we're confident it's a later project that we'll do. It'll be a relatively minor project, bigger grading on the other campus's side, and then putting in a gate that will have access for emergency, so but the fire department will have access, and we'll probably, police and us, but it won't be a road.
Would that be something we'd expect the owner of the university to pay for as opposed to the district?
We would have those discussions with them, knowing that it's really a requirement for them, and it's a benefit for us, so. We know who's gonna purchase it.
But we're gonna be prepared for it now, so
Yeah.
we're spending the money now in preparation for that.
We're doing grading on the site anyways, so we're making sure that the grading we do allows for
And that's for that
It,
access.
to happen.
It's not a huge expense. We've just recently had new cost estimates. That particular grading is not very onerous for Mid-Penn. It's on this side of the site. It's a lot more work for.
Of course, yeah.
But we're making a decision now on where on that property line is most beneficial for us, given our rest of the use of the property.
And you
right?
can see the curb kind of comes down here and here, and this connection existed at one time.
Yeah, it looks like it's probably the most
Was a road there many years
most
ago.
opportune location. It's probably the best.
And that's where the
Regardless.
PG&E is.
Yeah, the
Yeah,
PG&E
you
has been
could
overhead, yeah.
see the power pole here and that's these light lines or the shadows.
So we couldn't build anything there anyway, so. That's right.
Makes the most sense. Yeah, absolutely.
Yeah, works well for us.
Yeah, we can go to the next one. So just some thoughts about, the site development. The drawing that you see overlaid here is the civil engineer's drawing showing, the grading. But all the stormwater has to be dealt with on site. So these indicate bioretention areas where the runoff from these roofs is collected and then filters into the site. We are adding the new crane here, which triggers a need for a new transformer from PG&E. So we'll make a hole in the fence and the new transformer will be located there. The trailers are gonna be from Dairy Lane are gonna be relocated. This is the middle building. We're gonna have a pad for a portable mobile generator with hookups that'll run the entire site. And the 2 new EV chargers, accessible parking here and here with kind of new grading to make all the accessibility work for the site. Landscaping, new drought tolerant native landscaping, a new irrigation system. And more of this one.
Well, and we're hoping, the landscaping will be very nice, drought tolerant. We're going for almost all native. Hopefully we can get all native plantings and then it'll be useful for, you know, Drew to use as a demonstration garden. You know, we'll see how you know, turns out we might host, so we periodically host,
The Bosco.
Bosca, through Bosca.
Yeah.
Different conservation
Classes.
workshops,
Workshop,
classes,
yeah,
so
Master Gardener.
it'd be
class.
great to have a native landscaping class there and have our demonstration garden right there. It'll be,
Great, I think you anticipated my question, which is how we were gonna use this, or if we could use it to demonstrate good water resource use, like we're doing rainwater collection and that kind of thing.
Yeah, I was gonna mention, because we offer rain barrel rebates as one of the
Yeah.
conservation programs, so definitely would love to like have that installed there, so we can like show customers, hey, here's what you can do with this rebate. We have some like smart irrigation controller rebates that we offer too, so yeah, having all that set up here and having some periodic, you know, quarterly thing, or maybe, you know, semi-annual, you know, event, we're gonna invite members of the public and, yeah, just like show off, like, here's what you can do and here's how you can make your gardens more efficient. Yeah.
Very cool.
The landscaping plan would count for that transformer. It looks like there's an existing tree.
Yeah, so this tree is actually gonna be removed. It's a 2-inch tree, so to allow access to the.
Yeah, because from the street, PG&E is gonna want to be able to get access to that transformer.
Yeah, luckily it's a very small tree, so it's
Yeah.
going away. It's not a heritage tree, so we're not in trouble with the city of Belmont, so it's so far so good.
Right. Yeah, that and the generator pad looked like they weren't really considered, but yeah. It's still early days on the plans.
Yeah, well, we are heading for a permit first of next month, so so these drawings we're in the process of next few days collating them, and we'll be filing for permit next week sometime. I'm not positive what day, but they're moving along, and we're gonna file for the building permit while the kind of planning issues, the zoning is also going on, so they'll be kind of convergent. So I don't know how much detail I should get into here, but this is the lower floor of the existing building. Right now, most of it is kind of a garage. We're keeping part of it as a shop area, adding a bathroom, some mechanical rooms, and this area will just be kind of an open office area. Polished concrete floor, some kind of sound attenuation panels on the ceiling, but otherwise kind of left pretty rough, but you know, I think it'll be actually nice room, two new large windows on this side, so. So that's the first floor, the second floor. So these two areas, an apartment or an office or a bunk room is what we're calling them, so they'll be permitted as residential uses as part of our building permit, a kitchen, bathroom, shower, and another office area. And just some images of the new kitchen and the bunk room. And this is the upper floor office. 2 new windows. Layout space. Metal building, it's kind of an open shop space, a new crane, big roll-up door, layout spaces, storage, a utility sink. Yeah, very basic. And some exterior materials, we, obviously the existing building is stucco, we'll repaint it. Currently, we're showing the metal building with wood siding. The planning department may not let us do that, so we'd probably be a painted fiber cement of some sort, on the exterior, and then, kind of, polycarbonate windows and standing seam metal roof.
they very much want it to look residential like the rest of the neighborhood, so.
Yeah.
Although, you know, I will point out that you really can't see the building from the street level,
Yeah,
because of the slope. So you know, we heard that with the couple of community members who showed up at the 2 open houses that we held. But it wasn't very heavily attended, but I attribute that to our very detailed brochure that we handed out. They had all their questions answered, so they didn't even.
But the houses from on top of the ridge could.
We'll see
could
the
look
roof
at
for
the
sure.
roof, you know, so,
So, you know,
Yeah.
we're mindful that it'll.
although the trees
A nice
will
look.
probably hide a lot of it,
Yeah.
but they will be able to see it.
Yeah, from Folger Drive, it's pretty invisible.
Correct, yeah.
All
All
the
of
edge of it through the gate, but otherwise, like
Yeah.
you said, you'd have to be up high to see.
Correct, yeah, correct.
Some interior materials, for the second floor carpet, like I said, on the lower floor, we're just gonna polish the concrete. Resilient tiles or, flooring for the, second floor kitchen and, kitchen cabinetry, there's a very small area of tile for the backsplash over the kitchen counter and, stone counters and wood veneer cabinets.
And we're definitely keeping in mind that this building isn't going to be fully occupied all the time, like, you know, Dairy Lane will be, so. We're, you know, these are pretty minimalist finishes that we're doing. You know, we had discussions, we looked at the ceiling tiles that they have up there, they're. You know, original from the eighties, but they're fine, so we're not, you know, replacing those. Tom mentioned, you know, downstairs, which is currently that kind of, it's a garage area, the whole, you know, the entire building is a garage area with 4 or 5, you know, roll-up doors. We're converting part of that to office space, but like that floor is just gonna be polished concrete. I mean, you know, it'll be fully functional, nice, certainly the public can come for anything, but.
We're gonna have carpeting on the second floor though.
Yeah,
There's carpeting now, but
Yeah.
I just gotta replace it.
I think in the kitchen area, there's gonna be some kind of resilient
Yeah.
flooring.
Flooring,
And then the
yeah.
bathrooms will have a large format tile on the floor and some, you know, basic tile on the walls, wainscot.
Hey, polished concrete is in today, you know.
Exactly.
Yeah,
Nice
it's,
exposed ductwork.
it'll look, you know, you can open up a cafe.
Or Chipotle.
We can sell water.
Especially brewed.
Professionally brewed.
Just
Water and yoga.
getting into the weeds a little bit, but we are doing a seismic upgrade to a kind of a level 4, they call it, which is a pretty high level EOC kind of level of seismic resistance. Some new foundations or these large rectangles, and we're using kind of prefabricated shear panels. They're steel panels that you kind of bolt into the foundation, into the structure. So it's pretty efficient.
So you're going to have to take down those walls to put in the new foundation?
Yes, so, but luckily, we're leaving all the major columns and steel beams, so there's actually gonna have to be very little shoring of the existing structure.
Oh,
So we're working around the large structural pieces and just putting these lateral resistant walls in where we need to.
okay. And then they have to carry some type of resistance shear walls up through the second floor?
They're yes.
They
yeah.
have to go to the
That,
roof.
particularly these two, these
Yeah.
go all the way up. These, I think may just go up to the first floor and grab that
That diaphragm
floor
floor, yeah,
structure, exactly.
okay.
Those would be low beam, right?
Well, the steel beams are the load bearing portion.
Yeah,
Yeah.
they're the gravity part, but not all the work we're doing is actually all lateral, all seismic resistance.
Right.
There's no, there's no gravity needed. The building is actually stronger than your earlier structural reports indicated, because they didn't have the existing drawings and they didn't do destructive testing, and we realized, oh, there's a lot of steel in here already. So the seismic
Yeah.
work was really minimal.
Well, if we're
Relatively.
going to level 4, it's a lot more than what you'd expect for most buildings.
Yeah,
No good having an emergency operations center that falls down in an earthquake though.
Exactly. Or is unusable anyway, yeah.
yeah. No, it's a really robust little building, without doing anything to it, so.
Mhm.
Just, new site lighting, the transformer we talked about, new electrical distribution. Again, a kind of a hookup for a generator somewhere in this area. And, new mechanical systems, in the existing building. We're getting rid of the gas service, everything will be electric.
And the thinking of using a portable generator, I mean, certainly we could, have a permanent one, but if we have a portable one, there, whatever circumstances, if we, another generator at a, pump station fails, we can move it for that purpose too. So it just gives us a little bit more utility, electing for a portable one.
Where is our sewer lateral?
It actually runs.
It runs down towards where the gate's going to be, yeah, down there, like that,
Diagonally
right?
this way, and I think
So it goes through Notre Dame.
it does, yeah, and we're redoing it, I think, I forgot the scope, but it's
Yeah.
being
It's
redone.
gonna be, yeah, redone, it was televised or videoed, and I guess
That's right.
it needs to be replaced,
It
yeah,
needs to be replaced.
yeah.
Do we know how far downstream we have to replace it?
That I don't know.
I
I'm not
think,
sure if it's
whether
I
on-
think
only
just
on
on our
site or-
property,
I think it's just on site, but yeah.
yeah, just on site.
Okay.
Let's see, so,
And, but, this, okay, then, we're gonna hook up to Notre Dame. There's no sewer, laterals to that main. Until you probably get to the building, because there's no buildings, from the Notre Dame part in that area. So that's gonna be an area where the sewer lateral's not, it probably hasn't been used for a long time.
But there's an existing
Good,
building
we're-
just to the south.
exactly,
Just
we're
to the west.
replacing the line on our property, but the connections are existing.
Right.
So, as you say, the condition of the sewer lateral on Notre Dame property, we don't know.
Exactly, yeah,
But we aren't really
We're not
increasing,
increasing flows particularly.
yeah, so,
Yeah,
yeah, but the condition of the line itself, who knows,
right.
It could be
Notre Dame
outside,
property,
it could be collapse, it could be, who knows, But that's a parking area.
And do we know what the easement is for it?
We haven't looked into it now.
Maybe a question.
when we were talking to the same civil engineer that's working on our property was also working with Stanford. And so there was a lot of scrutiny around that connection. And as far as I'm aware, no one mentioned an easement for the sewer per se. It was all about the PG&E overhead, but
Yeah. Well, it has to run through private streets through the campus.
That's right.
Type of thing. So exactly what that would entail legally, I don't know.
I don't think anything for you.
Yeah,
Right.
But,
Well, if they try and disconnect our service, then at some point in the future, then that would be a problem.
that would be a problem.
It's been connected all these years.
it's been connected, and I mean, we
Yes.
use the facilities out there from time to time, not always, but we're in the
Oh, yeah,
building,
but,
and it
but
works.
20 years ago, 25 years ago, it was used constantly, it was
Probably,
the only building we
Yeah,
had.
right,
So
right,
everything was going through.
yeah,
I mean, why would it be any different now? It's, my concern was that it has not been used, a part of it has not been used for about 25 years at least,
Mhm.
except the little use that maybe.
Yeah, I mean, I understand that the guys fairly frequently, when they're out in the field, they go to Folger because it's a lot closer than going to Dairy Lane if they need. to use the
Correct,
facility,
correct,
so-
yeah. But
A few times a
if
week.
the line is offset and there's little use, you won't even notice, it's gonna go into the.
It got TV though, so.
Yeah.
Well, at least on our
Yeah,
side.
yeah.
Oh, you're talking about on the public side, on the public?
No,
facility?
south
On
of
their
the
side.
On
property.
the Notre Dame.
On the Notre Dame side.
Yeah, but that's a public sewer.
Well, it's a public sewer, but it's running through
It's-
private property.
Yeah, that happens.
Yeah,
I mean,
we've got a water line that's.
So usually they have to put an easement.
Right.
Yeah, exactly.
So
It's a public utility.
I think that's a city-owned sewer
It
line.
is a city sewer, yeah.
Yeah, so it's up to them to maintain it. It's not, I don't think we should have any concern about that, in my opinion.
Yeah, I agree. I think it's not your problem. It's your problem. Until it starts backing up on the Notre Dame
Yeah.
side. I-
But even then, I mean, then we have a claim into the
Yeah.
city, so
Yeah.
it's not, yeah.
So, I think we were at the board with an earlier cost estimate for this work at about 5.4 million, 4.1 construction cost, and this is total project cost. Our recent estimate, based on basically the permit drawings, we just received it a few weeks ago. Construction costs are at 4.4 million. That includes 10% contingency and 7% escalation. So typically escalation would be 5% because of the volatility in the markets right now. All our estimators are increasing the percentage because of tariffs and other things. So this number kind of consolidates that. So we went up, and this is the estimate of the, the total project cost right now. Up to now, the bidding, particularly the last 6 months, the bidding environment has been very competitive. It's hard to know when this goes out to bid in the summer, at the end of the summer, how things are gonna be, so. But that's where we are now.
These cost estimates are pretty fresh, so I think you're still looking at them. We need to maybe also look at them in closer detail. We'll look for, any opportunity for cost savings that we can. It's a pretty bare bones project as it is, not a lot of fluff, but we'll see if there's any opportunity as well.
We also asked the estimator to put in some higher numbers for the metal building. So in addition to her their contingencies and the escalation, we also kind of pushed for a little more money just for caution. So I'm hopeful that the bids will come in lower, but anyway, that's where it is.
But at this time, are you looking at any potential materials changes because of?
There's not much to cut out of the building. I think, Kat and Ren and I have discussed this. The only real, luxurious item would be the large windows in the old building. So that's not gonna save a lot of money, but it's a few dollars. But otherwise, there are no extravagant materials. There's not really. We could take the crane out. I guess we could play around with it, but it's just.
Yeah, the crane's really necessary if that
Not that
becomes our primary.
Yeah, it's not an expensive purchase
Shop.
either.
Yeah, it's about $10,000.
And, the kitchen, certainly the cost to put in a kitchen, but. If that's an emergency operations center where people are living kind of, for an extended period of time. Also, you mentioned it's a 6-bed bunk room. Well, we have operators. There's always a certified operator on call 24/7. Some of our operators don't live within the 30-minute response time. So we currently have an office trailer, part of an office trailer that's converted into a bunk room at Dairy Lane, but that we offer as a benefit if you want to use it when you're on call, and it's definitely a big benefit for those that don't live close by. It's also, a benefit if you respond to a call late at night and wrap up late at night and don't want to make it, all the way home. That's available to any employee who has to do that. So that benefit will continue with a larger bunk room, of course, at this place. And so if you do that, right now it's really bare bones where they just have a microwave available in the shop. So this will be a little bit better, having a kitchen for that purpose too.
I think that may be it. Oh, next steps. Yeah, planning commission hearing April 15th. And then city council meeting, this is an estimate, but early May for the approvals. And like I said, building permit submittal, it'll be at least 2 months of working through the process of the permit before it's issued.
So the planning commission hearing, the city is putting their presentation together. They're giving the presentation. I'll be there and Tom will be there, if there are any questions that come up from the commission. But it should go smoothly. We haven't had any indication otherwise.
Yeah, the neighbor's response was minimal,
Yeah.
but interest is relatively low. Yeah.
So the top part of the schedule we just discussed, bidding maybe, into the summer. We're estimating a year, September to build it and, close out sometime September, October, move in November, 2026.
So in November 2026, I heard that we could potentially have some of these meetings. These, like, the board meetings up there.
So our plan for phasing. Is for Folger to be complete and for us to move out of OCR
So there.
and over there. So we would then switch that to be the board member location if we lose this space. And save on rent quite a bit, so.
Yeah,
And that's the goal, we'll have to,
Yeah.
look at the phasing. So we have an RFQ put together. That's written really looking at the program management side, and so one thing we want is someone to help us work through all the logistics of that phase. As well as the moves and someone else to put their mind to all of that too, to make sure that we stay fully operational, so. Hopefully, when we really look at it closely, that will work. It's a lot to basically move most of the operations there while we're doing construction on Dairy Lane, but that's the goal. So that we can get out of the contractor's way at Dairy Lane as much as possible through that construction.
Good, yeah. Yeah, that'd be great. That'll be a full circle for me. I started there. Yeah. But yeah, I mean, that's the smart way to do it, is we'll save what we're paying here,
Yeah.
Very good.
And for Joanne's benefit, we do have, a lease, we extended it, and then we have, I should have looked it up. Do
Thought it
we
was
give
a
ourselves
3-year.
4 options or 3 1-year
I thought
options
it
to
was 3
extend?
1 year.
So I think, yeah. So we're good here for a good 4 years if we, 4 or 5 years, I can't remember,
If we
but
exercise.
if we want to, but they're 1 year.
These are, yeah,
extensions.
options, yeah. So for the planning commission meeting, we don't anticipate there's gonna be any public outcry.
No,
But then it's gonna go to council, right?
yes, and we're told it's gonna be on consent calendar,
Okay,
so. I don't anticipate discussion, but I'll be present at that meeting too.
and the council, there is a possibility that maybe there'll be somebody who wants to do some little grandstanding. Running, probably not, but council, you may find
You never know, we'll be
Yeah.
present, we'll
the comedian up there,
be
so
there to discuss it.
hopefully nobody will show up, yeah.
Yeah.
And it will be
Need it to
consent,
be
yeah.
Presents, you just let us know.
We have any indication, we certainly will, but, we'll put it there.
So, I mean, based on the public that showed up, there shouldn't be any.
Yeah,
That would be what we should tell you, where were you when we had the open house?
Yeah. if so many conferences in March and April, I actually need
Yeah.
to check if it's gonna be on
That
it.
doesn't mean that somebody who was objecting to the rate increases wouldn't want to go there and
Of course,
make some.
that's why
statements.
I said, there'll be some joker who'll go.
Never know.
Yeah.
It's the public process.
Okay.
Yeah. Good,
Any other questions? Go ahead.
that was good.
Okay,
Thank you so much.
Tom.
Yeah.
then thank you, Tom.
Yeah, good to see you again.
Good
Yes,
seeing
I think
you.
you were at the public meeting last time.
Yes. I made it there. I made it to a couple of the public meetings. and it was Free donuts.
As many as you can carry. Feel free to, take a cookie or two, brownies.
On my way out. I will. It's good to see everyone.
Thank you, Tom. Thanks.
So moving on, the next item of business is our regular A. Presentation on certificates of participation sale.
All right,
Chad, you want to kick that one off?
Yes. Well, we have Rob Pankratz here from Wolf Hansen, everybody's favorite, and Bud on Zoom.
but
I mean, I could go over the staff report, but I don't want to steal his thunder, so go on to your presentation.
All right, we can do that, Bud. Do you want to get us started and say a few words?
Yeah, I would, I think this was a particularly impressive sale that we were able to put together, and the results are outstanding, as you'll see when we go through the specifics. And as we go through, I'll have a few comments to make on each of the each of the sections. I just want to say that, you know, we really appreciated the cooperation we got from the staff and the board. You made our job a lot easier by being as efficient as you are in providing all the information that was needed, and that resulted in you know, in an outstanding sale with very good bidders and an extremely attractive rate.
All right, thanks, Bud. With that, can we jump into the first slide, background? All right, thank you. So I'm gonna cover this part quickly because you guys know all of this, but late last year, the district completed a rate study and subsequently instituted a new rate structure to, among other things, support its capital improvement program. In support of its capital improvement program, the district determined that it would issue certificates of participation, or COPs, to fund approximately $33 million in district projects. On February 27th, exactly a month ago, the board of directors approved moving forward with this financing, which was to take place via a competitive bidding process. As part of the board's approval, the finance committee and board set not to exceed parameters for the financing that we had to operate under, including a maximum par amount of 35 million, a maximum true interest cost of 4.75%, and maximum annual debt service of 2.2 million. On March 19th, so a week from yesterday, the competitive sale took place and it was successfully completed with Morgan Stanley submitting the best bid and being selected as the underwriter for the transaction. On this slide, we show the bids that we received. We received a total of 7 bids. They're listed in order of TIC, so the strongest bids are at the top and the weakest bids are at the bottom. A number of these bids were submitted as syndicate bids, meaning that multiple investment banks teamed up together to submit a joint proposal. So a lot of the folks that we've been marketing these bonds to didn't submit their own bid, but they joined in on one of these syndicates and participated with 10%, 15% of the offering. So Morgan Stanley was the winning bid. They bid a 4.041982 TIC on the bonds before resizing. There's a pretty significant gap between Morgan Stanley's bid and Hilltop's bid. Hilltop was the cover bid of 4 basis points. That's a fairly wide spread because, as you can see, the rest of the bids are kind of clumped together. We kind of considered Hilltop and Jefferies like really aggressive, UBS and Mizro like not as aggressive but still on the market. Fidelity a little bit off the market. Well, Fidelity and Baird kind of way off the market a little bit. And with Morgan Stanley, we think they just submitted an absolutely very, very aggressive bid. And this is one reason why a competitive sale is a really great process for an organization like Mid-Peninsula, because you guys are an infrequent issuer. The last time you issued bonds was 9 years ago. So a lot of these banks aren't super familiar with your credit. Their customers aren't familiar with your credit. So if we were to do a negotiated sale and send out an RFP to all of the banks on this list, we would be very hard pressed to get a response from Morgan Stanley. It's not a large enough deal to really be sort of in their bailiwick. But when you do a competitive sale, most of the work is sort of front loaded. We give them a ready to sell product and they can make the economics work on a $33 million deal when we go competitive. So to put these in numbers a little bit, the difference between the winning bid and the cover bid submitted by Hilltop was approximately $195,000 in debt service over the 30-year life of the CIP. So 195 divided by 30, that's I'm not very good at mental math, $6,500 a year. Better Morgan Stanley was. If you compare the winning bid to the worst bid that we received, or I should say the least favorable bid we received, because we appreciate every bid that we receive. The difference between the winning bid and the least favorable bid was just over $1 million in debt service over the course of 30 years. So Bud, can you do the mental math faster than me?
Around 30,000, a little over 35,000, something like that.
Yeah, there you go. about $34,000 a year better in debt service each year for 30 years. So we're really happy with this turnout. 7 bids is considered a strong turnout. There are a few other banks who indicated interest, called us. We called them. They sent questions to us and they really dug into the credit. Ultimately didn't submit bids for a variety of reasons, but we're really happy with this turnout and we're especially happy with Morgan Stanley's bid. Let's hop to the next one.
So you said, Morgan Stanley was a syndicate. Have you figured out who all is in that syndicate?
I don't know who all is in the syndicate, but I know that DA Davidson is in that syndicate. I know Ramirez is in that syndicate. And there's probably a couple other New York banks that aren't super.
Rob, didn't we hear? I think there was 12 members of the syndicate. It was really a pretty, for that size deal. It was a pretty widespread syndicate, actually. And by the way, one other quick thing on that, Kat, did you get a hard copy of the official statement today?
I did. I got 2 hard copies.
Good. We made sure you did. If you need more, let me know. It saves you from having to print them out. But you'll notice that Morgan Stanley's name is not on the cover. Normally, an underwriter would be on the cover. But when they have a syndicate like that, in favor to the other members of the syndicate, they don't put their name on the cover. So when they're using it, they say give these to their clients. They don't have Morgan Stanley staring at them. They'd rather have nobody but just with Wolf Hansen as the financial advisor. So, but I wanted to be sure you had hard copies. You'll get a full transcript of the transaction electronically that you'll be able to save with all of the documents involved, including the official statement.
Only like a couple thousand pages.
Start more binders.
They are recently keyword searchable though, which is a big benefit.
Yeah.
Just one other note on the syndicate. When you get these big syndicates put together, this allows a lot of different banks and their sales folks to go and sort of pre-sell these bonds before they have to submit a bid. So a lot of these bonds were pre-sold to their investors. It doesn't mean it's like a binding sale, but they have an order if they win the bid. So they're able to bid really aggressively when they already know the price they're going to sell it to their customers for.
That's really incredible.
So on this slide, we show a snapshot of the tax exempt bond market. This goes from December 24th of 2024 to March 24th of 2024, which was just earlier this week. The blue line is the 30-year AAA rated tax exempt general obligation bond muni index. The green line is all of those same words, but for 10 years. So these are the 2 main indexes that the municipal bond market tracks. The purplish pink line is the day that we priced. So had we priced in basically any week, except for maybe the last few days in January, we would have been worse off from an index standpoint. We would have been a little bit better off in February. There was a decent amount of volatility, not a ton of volatility. And in March, we seemingly priced at a good time in the month of March. Rates are up about 15 basis points since we priced last Wednesday. Rates have really been shooting up over the last few trading days. We've actually seen a number of other transactions scheduled to price and then get pulled because of either volatility or the indications weren't coming in where the team and the client expected. So they decided to pull and maybe test their luck in a couple weeks or a month. So we think this is really strong timing. You never know exactly what's going to happen any given day or week in the market. Most of the volatility over this 3-month period is just really a function of the latest thing that comes out of Washington and if that's real or not real, or I don't need to get into that. But let's hop to the next slide. So these are the comparable sales, and I was planning to spend a lot of time on this slide, but if I'm getting too granular, feel free to let me know. Mid-Peninsula is in the middle, highlighted in green, and we have 4 other water agencies that have issued bonds in California in 2024 that are relatively comparable to the district in terms of the size of their operation, their credit quality, the fact that they're in the market. and the type of financing that they issued. So the way to, and I'll actually just pop up here, a little pointing as well. The way to look at this is we're comparing this first column, it's called the B-val column. This is the index that was shown on the last page, but for each individual year, as opposed to just the 10 and the 30. And so the way that municipal bonds price is you take the index and then you assign a spread, and the index plus the spread becomes the yield. And so what we're comparing when we compare how your bond priced to other bonds priced is the spread. Because on any given day, the index will be different, but the spread to the index is what normalizes it. So if we look at this first one for Coastside County Water District, the index for a 1-year bond was 2.79%. And if you add 6, you get to 2.85. So that's how we price municipal bonds. A plus spread means that you're getting interest rate points added above the AAA rated curve. So anything below AAA should get a plus. If you have a minus anywhere, like some of these on the outside have, that means that you're actually pricing better than AAA rated general obligation bonds as an aggregate at that time. So in each year, we kind of want to compare our spread to what these other agencies got. So for Coastside County Water District, is this big enough? Do we need to zoom in for folks to
Can you
see?
zoom? Yeah.
Is
Zoom would
that
be good.
a capability we have?
Yes.
And maybe if we just show these first 3, and maybe the top half, we'll jump to the other ones later.
Well,
Maybe 1 or 2. One more, all right. And then let's scroll down just a little bit. Great. So we are pretty significantly better than both South Tahoe Public Utility District water revenue and Coastside County Water District. Coastside County Water District had the same rating. Their underlying rating was a half notch below, but this presumably was an insured deal, which allowed it to trade as a AA. It was a $7.7 million transaction, so a little bit smaller, a little bit less attention in the market. And this was a negotiated sale, negotiated with an individual underwriting firm. To the left, we have the South Tahoe Public Utility District. This was a little bit bigger of an offering. I think that says 14.2 million, but still not quite as large as the offering we had. They're a half notch below in rating to the district's bonds. The district's bonds were rated AA by S&P. These bonds are AA minus. And again, we're significantly better than them in virtually every maturity. And we're even a little bit better than we expected to be against these folks. This was also a negotiated deal. Coastside County was D.A. Davidson and South Tahoe Public Utility District was Oppenheimer. And let's scroll a little bit the other way now. Now let's look at some deals that maybe priced a little bit better than ours did, and let's talk about why. So over here we have, I'm going to start on the far right with the Mid-Peninsula Water District. They're a very, very large water agency. So from that standpoint, they're not as comparable. They're sort of a known entity in the market. Investors are more familiar with their credit. They issued just over 70 million in bonds. So they were able to attract quite a bit more attention because of the size of their offering. They were also rated by 2 different rating agencies and received AAA ratings from both rating agencies, which is 2 notches higher than our rating. So understandably, they had better spreads than we did, but only by 20, 15 basis points in any given maturity. So given those differences, we think it's pretty favorable. The one that sort of caught our eye and seems a little bit odd is the Marina Coast Water District. They're about a $17 million offering, so more comparable to the Lake Tahoe offering than the Mid-Peninsula offering. And they had a AA minus rating, which is a half notch below the Mid-Peninsula's rating. And both of these were done competitive sale, with the winning bids being Hilltop Securities and Fifth Thirds. So we dug a little bit deeper into the Marina Coast Water District to see, like, how did they get such good execution? Did someone mess up their bid? What happened? And the conclusion that we came to is that they really got an unfair shake by the rating agencies. And the rating agencies gave them a not pristine credit rating despite their very pristine financials.
Interesting.
They actually are a water and wastewater agency, so they have revenue diversification. They have a little bit more than 10 million every year in net revenue above expenses. They have significant reserves. All of their debt is shorter term in nature, and their debt service coverage ratios are 100 to 200 basis points higher than Mid-Peninsula's water districts. So the fact that they got a AA minus rating is very surprising, and I'd be curious to see what S&P's reasons are for that. I suspect it primarily is to do with water resiliency.
I was gonna say, they have a much less secure water supply. They have saltwater intrusion into their wells. They have some groundwater contamination. They're obligated now to supply Fort Ord as it gets redeveloped. They have.
That would explain the
They have their
huge jump in their
obligation.
projected expenses or its projected revenues going forward.
They might have been a client. Whatever you call it.
Hey, Rob, also, you might point out, it is Hilltop Securities that bought this, Miguel, Marina Coast. They were the cover bid on ours, so they had an opportunity to buy ours and did not bid as strongly as they did for the other.
Yeah, so Hilltop was our second best bidder,
Yeah,
so
exactly.
I think that's noteworthy. That underwriting firm did look at, the district did submit a bid. And that's how they saw that district versus this district, which is sort of a flip to how S&P saw your district versus their district. So it's always interesting. Folks have different opinions on forecasts and
Exactly.
the right amount of.
I think what
If I'm
gets
not
us-
mistaken, Rob, wasn't that a day difference? Didn't they? I think they came to market a day earlier than ours.
Hilltop was a winning bid for the
Yeah, so-
Marina Coast.
So this was
Yeah,
also a
yeah.
competitive sale, and Hilltop Securities was the winning bidder on that transaction. Are there any questions on the comparables before we move on?
So, Rob, you started saying that the difference between the negotiated and when you go out to bid. But the ratings is known anyway, regardless of whether you're
Correct.
negotiating, okay, so why would the bid be the better way to do it as opposed to negotiating? When the rating is still the same, it is what it is, right?
Well, it's not necessarily true that a competitive bid is always better than a negotiated bid. If it was cut and
Okay,
dry,
so
it wouldn't
when you
be.
started, that's what I understood, that we did better because we went to a competitive bid instead of a negotiation.
There are certainly advantages to a competitive bidding process, and I think those advantages are, you guys are particularly well suited to take advantage of them. Because on one hand, like the case against doing a competitive sale is you're an infrequent issuer. You might want that white glove service from working with an underwriter who's gonna come meet with you in person and walk you through their marketing plan and things like that. You have the benefits of potential syndication, but you also have the risk of not attracting very many bids. You could get 1 or 2 or 3 bids in a competitive sale if either the marketing was botched or there's a lot of competition that week for the interest of banks. Cause there's a whole calendar every day of competitive deals that these banks can bid on. So you kind of have to fight for their attention to get them to do that initial credit work and then submit an aggressive bid. So a competitive sale is a little bit more of a gamble. A negotiated sale, you kind of know what you're gonna get. But competitive sales have the opportunity to sort of outperform because you're fostering a competition, you're fostering folks to be aggressive,
Yeah.
but there's no guarantee that actually materializes. Good question.
Okay.
And yes, the rating is completely independent of that process. So here we show the sources and uses and some summary statistics. And we compare that to the good faith estimates that were shown to the board when you approved the financing on the 27th. Do keep in mind that interest rates went up about 10, 15, 20 basis points, depending on where you're looking at on the curve between when we provided our good faith estimates and when the bonds were actually priced. So we show the sources and uses of funds at the top. just under 33.5 million in total funds. That's made up of 33.1 million in the par amount of the certificates, as well as the net premium generated of 388,000. The net premium comes from the coupons being higher than the yield. So you have, let's say, a 4% coupon on your bonds, you're paying 4% interest to the investor, but you're only paying the interest on that amount, and therefore your yield is reduced. So your yield is your actual cost to you. So the investor gets a higher check, but you get this money up front. That's kind of how premium bonds work. It sometimes takes a while to wrap your head around that for some folks, but that's generally how almost all tax exempt bonds are priced. Here we have the uses of funds, the $33 million in project funds generated, the cost of issuance for the financing and the underwriter's discount bid by Morgan Stanley. The expenses across the board came in a little bit lower than we projected, roughly 50,000-60,000 cheaper than what we had projected. So that's always a nice win. And then we have our summary statistics below, the dated date, which will be the closing date of the financing, the first par call date in December of 2035, and the final maturity in December of 2054. We have the true interest cost of the financing. That's a 4.0573. So we rounded that up. Interestingly enough, 1 basis point better than what we had projected a month ago. Very unlikely that we're that close in our projections, but a broken clock is right twice a day. So we'll take the win on. Go ahead, Bud.
Yeah, I just wanted to say, this is always the toughest part that we have as a financial advisor. This rule came in about maybe 4 years ago, where you had to include your best estimate of where the bonds would be priced when you're attaching it to and you attach it to the resolution of approval. Many times we're doing that resolution 3 months before we actually do the sale. In a negotiated situation, sometimes it's 2 months. In this case, we were 1 month with the competitive sale. Because of what happened in 2016, and you probably remember, we had without having the requirement of providing this kind of an exhibit, we did talk about where we thought the bonds would sell, and the market was moving very quickly. We sold the bonds at a very good rate, but the rate actually, a week or so later, came down, so we weren't as close as where I would normally like to be. We really put a lot of thought into this one. Rob did a great job on looking at the market and understanding all the comparables and why they're priced the way they are. I put on my thinking cap and really tried to exercise as much experience as I have in projecting based on everything that was happening in the economy, and the new administration as to where bonds would be when we got ready to price. I absolutely had no idea we would be this close. This is the closest I've ever been in making, or that we've ever been in making these kind of projections. So we're kind of proud of that fact. So, anyway.
Yeah. And to just sort of give one example of the level of attention we gave to deciding when to price on this, we actually did something that's typically considered unusual. We chose to price on the day of a Fed meeting, which typically most people do not like to do because those are often very volatile days in the market, and you do not want to price on a volatile day because people are not going to be as aggressive with that introduction of volatility into that short period where they have to hold the bonds before they sell it to their customers. But we strategically decided to price on a Fed day because of the size of your issue and some of the other issues that were coming up the week before and that week. There were a couple multi-$100 million state of California issues. And so we did not want to have to compete with those issues. We wanted to price on a different day. And in fact, the day we priced, we were the only competitive sale in all of California. So folks who have California customers and folks who want to buy California bonds, we were the only game in town that day from a competitive sales standpoint. And we thought that would attract aggressive bids and a lot of bidders. Bud is really our markets guy and really has his pulse to the ground. And he sort of had some insight on what the Fed was most likely to do that day, which was nothing, which caused the markets to be relatively calm that day. So we think that went over really well. We consulted with 5 or 6 different underwriting desks about that decision. before we finalized it. And ultimately, we believe that it proved to be a correct decision. One other thing I want to point out on this page before we move on is you might notice the TIC here at 406. It's really like 405.7. And you might see the bid from Morgan Stanley a few pages ago, which was like 4.046. So why are we a basis point and a half higher than where the bid came in? And that's a function of how we solicit bids. Because municipal bonds typically sell with different coupon rates and yields, that can kind of cause the cash flows to get wonky. Well, one year you'll have a really high payment, and then one year you'll have a really low payment or no payment. So what we do after we determine who's the winning bidder is based on the scale they give us, we normalize the principal amortization so that you have roughly level debt service payments every year. And so that caused the approximately 1 basis point increase to the true interest cost. That was true of all the bids. Any bid that we repriced would have moved a basis point to a basis point and a half on a TIC basis. So in any instance, Morgan Stanley bid, it's not like that would have pushed another bidder above Morgan Stanley. And then lastly, the ARB yield for these bonds is a 4.01%. That is the maximum amount that you can earn in taxable investments. If you are able to find a tax exempt investment, you are able to earn above the ARB yield. But where the market is right now, I think it's unlikely that you'd find a short enough term tax exempt bond that was highly enough rated to meet your investment policy to out earn that. But if markets change, that's certainly a possibility and something we can keep an eye on for you.
Rob, I think, let me just here for a second too. When the deal closes next Tuesday, the 33 million in the project funds will be invested immediately in their money market at Bank of New York. But then you'll have the opportunity to decide how you want that project fund invested. And we would like to have a conversation with you next week before you make that decision so that you could take a look at what your draw requirements are going to be on the capital projects so that we can recommend how you time those investments. And we would recommend initially that you do the same kind of a laddered program with treasuries that you're currently doing with some of your reserves, because you'll earn just about, or maybe even a little bit higher than the amount of the arbitrage yield. At the end of 5 years, you would do an arbitrage report to make sure you haven't over-earned. If you over-earned, you don't pay a penalty, you simply pay a rebate. But it can be structured so that you can get a little bit more in earnings in the first couple of years. And as you use the money, you then invest the balance in lower amounts so that you always stay ahead of that arbitrage, but you get as close to earning what your interest rate is that you're paying on the money in the project fund, which offsets some of your debt service requirements.
Thank you, Bud. All right, and then a little glitchy. Here we show the debt service schedule, the coupons and the yields for each year, the total interest, the total debt service, and generally this will be your annual payment schedule, although your interest payments are semi-annual, just like your 2016 certificates. So $33.1 million par amount, raised about $33.5 million in total proceeds. Total debt service of $57,767, and our estimate was off by about $100,000 over 30 years. So we're happy with that.
Yep.
And that's our presentation. Congratulations on a very successful sale. We will be closing on April 1st, and if you have any questions, please let us know.
And that's not a joke.
No, no, April Fool's Day.
We're priced on a Fed day. We're closing on April Fool's Day.
You really getting okay? You get money in Monopoly money.
Rob, you want to talk a little bit about the payback or the early payment?
The callability and the redemption.
Yeah.
Yeah, so these bonds have a standard 10-year par call in December of 2035. These bonds can be called for just the remaining principal amount, which either means if you have sufficient cash at that time, which would be unlikely that you'd have enough cash to want to pay off the bonds. You can do that, or you
Money
could-
here, you didn't know that, right?
Yeah, exactly.
Yeah, go ahead.
It's all in the tanks, right?
Yeah.
Or you could refinance at par at that time if interest rates are favorable.
Exactly, yeah.
Or you can increase the amount of payment you're making in any given year after that 10-year period to accelerate the payments on a yearly basis out of whatever funds you have.
Principal. You're paying part of the principal.
Yes, you can pay additional
Correct.
principal. Yes.
Yeah.
You also will have some savings without even refinancing, because now that you've issued just one bond instead of two, you can watch the rates climb for the next 18 to 24 months and just realize that that's free money in your pocket every time that rate goes up.
Yeah. Cool. Good. All right, thank you.
Thank you so much.
Yeah, thank you,
Yeah.
guys.
Great work, guys.
Yes.
Thank you.
Yeah.
Okay. No. Little bit to go on.
All right, thank you, Rob.
Thank you, guys.
Yeah,
Good night,
thanks,
Rob. Good night, bud.
Night,
Good night. Thank you very much.
Thank you, bud.
Don't forget to grab.
Yeah, good keys and your jacket.
Don't forget those.
Mhm.
These are stylish.
Okay, so agenda item 8. So we have ordinance 130 rescinding our level 1 and authorizing level 0 water storage response. Shortage.
Yes.
Okay,
So if you recall, when we came out of the last drought, we, instead of going to no shortage response, just 0, we continued the district's practice of staying at level 1 shortage. The thinking was it, promotes the value of water. It's a continued message to our customers to always, be wise about your water use. But, looking at conditions, and Drew did, some analysis on our recent demand patterns as well as, in drought recovery. We have a different recommendation now, so I'll let Drew walk through his presentation.
Yep.
And-
Okay, so, I will get up as well, do some pointing. Yes, so. Okay. Yeah, so basically, I took a look at some of our water use patterns, particularly like during the drought, just to figure out, what our customers' actions were and how we did in terms of water demand reduction during those droughts and comparing to like baseline non-drought years. Just as a quick overview of our water use, so in this last year, looking at 2024, and this is similar for, most of our data, we're primarily residential use, so like 73% of residential, including single family and multifamily like apartments. And roughly 15% of CII use, so that's commercial, industrial, institutional, basically non-residential use. So, primarily it's in the single family sector, about 54%. But yeah, primarily residential water use is where our sector use is. So next slide. Oh, sorry. And the proportion of that residential use has actually increased over time. So since 2016, that ratio has increased by about 8% into the residential sector. So we've been shifting more towards residential use as opposed to, relative to the other non-residential uses. So when looking at our per account water use, this is like the average amount of water each of our accounts use within each of our use sectors. Looking at that over time, the general trend is that our per account water use has been going down since 2016. So basically, indicating a higher efficiency of water use within those customer sectors. Some notable patterns here, we see in 2020, a pretty big increase in our per account water use in the residential sector. That's, likely large thing, to do with COVID-19 and shelter in place ordinance. Basically, everyone's going in home, everyone's staying at home, working from home a lot more, using more water, and we see that trend in the water use patterns in that year. And we see a flip side with the commercial use with a pretty large decrease in 2020, probably likely to similar patterns, given the shelter in place. Basically, starting since 2020 and going into the drought in 2021, we see largely a decrease in water use and across most sectors. And then, with a gradual, slight uptick in 2024 coming out of the drought. This isn't quite the case in the commercial sector, as you can see, it dropped in 2020 and then gradually increased, throughout those years. So didn't quite see the same result, during the drought as we did in the residential sectors. But, notably, large decrease, increase in 2020, followed by a response during the drought in 2021, and then gradually increased, and then that big uptick in 2024. And this is just looking at it graphically, and basically starting in 2019, we see this increase in the single family and multifamily use, followed by a decrease during these drought years, and then the drought rebound in 2024. As I mentioned, the commercial was mostly stagnant on the per account use and then increased in 2024. The other sectors, it's a little bit harder to pull out trends there just because there aren't a whole lot of accounts there to pull data from. So it's likely that, there's probably maybe a couple of very large water using accounts that are shifting those trends. And, so just a little hard to pull out, any use kind of trends in those sectors.
So do you have an opinion, Drew, or whether or not this 2024 increase is just sort of a blip or the beginning of it? Water usage?
Yeah, well, I'll go into a little bit later. But it's common that after coming out of a drought, water use does tend to increase a bit, since, that messaging or folks know that we don't need to conserve water, or that pressure isn't as there, that we do see a drought rebound often. And we saw that during the 2014 drought as well. So I can show that in a bit, at a larger scale level. But yeah.
And you see that across the board with other agencies too.
Mhm.
There's always some rebound. It's very rare ever that you go to pre-drought levels. There's always a downward pressure after a drought, but there's some uptick.
Okay, that's fine.
Is there a reason for the institutional numbers going down in the past couple of years?
Yes,
It's so rather dramatic. Is it
Dramatic,
because
yeah.
Notre Dame closed?
I don't think Notre Dame was classified as institutional. I think there's a very few accounts that are classified as institutional use in our district. And so, on a per account basis, I think take an average, it's just harder to say what exactly is driving that. I don't remember the number off the top of my head. It might only be, like 40 accounts or something that are in that category. So it's a little hard to say like what exactly is driving that.
I was thinking more in terms of that this was a volume number. It's really a per capita number. for
Yeah,
individual.
Exactly. Use
And
per
so it
account.
is such a small number of accounts.
Right.
It makes a big difference.
Yeah, exactly. Yeah. So looking at a total volume level, so this graph here is looking at annual water use savings during the most recent drought, the 2021 drought. During each year of that drought, the 2021, 22, and 23, the total amount of water that we saved during that drought. So it's basically comparing against the water use in 2020 to the water use during those years and how much less water we use, right? The demand reduction during those years. And what we see, and we're looking at to answer the question, like, where do we really see the water savings during our drought? Like, which customers are actually saving the most water and are most responsive to our drought messaging and, drought actions? And pretty clearly, it is the single family sector that is conserving the most water. So we see, during 2021, 63% of all the water that we saved during 2021 during that drought was in the single family sector. 2022, it's about 86%. So the vast majority of the total water that we saved during the drought is coming from that single family sector. It's worth noting, most of our large majority of our accounts are in the single family sector. But that's, where we saw that huge decrease in water use. So, on the per account basis, that trend might be, the number might be shifts, changing very slightly, but on a total volumetric basis, it's a big impact. In terms of our non-residential use, it's pretty, the use was really all over the place. It actually saw an increase in 2021 and 2022 during the drought, followed by a 5% decrease in 2023. So, it's kind of all over the place and really not a good, indicator of water use savings during a drought, looking at that non-residential sector. Obviously worth noting here, this is compared to 2020, right? So we did see that big increase in water use in residential sector, during COVID, during the shelter in place. So that is obviously having some effect here on that big drop in water use. But even without that, it's clear that, this is where we're really seeing our drought savings potential during the drought. Okay, so next slide.
So,
Yeah.
quick question. So the savings that you're using here are savings compared to 2013 base numbers?
This was-
Or this is year over year savings?
So in that last chart, that was actually looking at 2020. So the year prior to the drought, comparing
Okay.
that water use to each year during the drought. So that water use reduction basically,
Okay,
from that baseline use from 2020 use. So this chart kind of gets to, Joanne, what you were mentioning. So this is looking at our water use since 2010. And this includes 2 droughts in this annual water use. And this is our total water use, not just residential. And what we see in 2014, a big drop in during the years of the drought, followed by this gradual increase in water use, right? So at the end of the drought, 2016, we see this big uptick and followed by a steady increase up till 2020, and a similar pattern during the drought. Water use reduction, and then coming out of the drought, that slight increase. So, it's likely that this trend will increase similar to the 2014 drought, that steady increase. But as you can see, water use has not rebounded up to 2013 levels, even during non-drought years in 2018, 2019, et cetera. So, what we're seeing here is that water use and water consumption for our district is getting a lot more a conservative, even while our population is increasing. So I think it's important to note that even though we are expecting some rebound during the drought, we aren't expecting it to go anywhere near like 2013 levels. If we look back even further, I think in our water supply assessments, we had data go back to year 2000, water use was way higher. So we've been seeing a gradual decrease in overall water use, even coming out of these droughts.
Bruce, so this is total water usage.
Mhm.
So residential, commercial, industrial, all that.
Mhm.
So how do you calculate the per capita for like day population versus, night population
Mhm.
versus residential people or people that don't live here, or how many people come into? How do you do that?
Yeah, so this number is just overall population. We're not taking into account like commuter or daytime, nighttime populations, anything
So
like
the
that.
population of our district,
Yeah.
right?
Mhm.
Regardless of who comes and who leaves.
Yeah.
Okay,
And that's based off of census data, calculations from, I think they have like census block areas, for the city of Belmont, and then some estimations of population outside of the city that we serve, like parts of the county,
yeah.
and other areas
Yeah.
but it's all based off of census level estimates.
And it was updated based on the 2020 census.
Yep. Mhm.
Yeah.
Yeah.
Cause I don't know, but my assumption is that the day population is smaller than the night population.
Mhm.
Yeah.
As opposed to the bigger cities, which the day population is much higher than right?
Mhm.
Our
Definitely.
people go somewhere else to work and then they
Mhm.
come back to sleep,
Mhm.
yeah.
Yeah, and it's rare that anyone calculates daytime population because it's a very difficult number to quantify. I think the only agency that does it routinely, and because they really need to, is Stanford. Stanford is their own water supplier agency and being, and their Boston member agency. And so anytime we're comparing and for the tier two, negotiation and all of that, they're just really their own animal, so they have to be looked at differently. Because they have such a huge influx of,
Of students, yeah.
Yeah.
Exactly, yeah.
and they also. They classify a lot of their use as institutional, even residential use. I mean, they're just very complicated. But typically, water agencies and cities don't.
Okay, thank you. Yeah.
Okay, next slide. Okay, so looking at our two most recent droughts, the 2014 and 2021 droughts, and comparing those to baseline years, what we can get and start to estimate is the total amount of water savings that achieved during both of those droughts. So I'm looking at this top chart here. This is comparing 2013 baseline in blue here to the water use during the 2014-2017 drought. So we see here, water use during 2014 relative to that same month in 2023, that same baseline month, and for each year of the drought. And what we see is an average annual savings across all those months of about 20%. So basically our water use reduced overall during that period of drought by about 20% relative to the baseline 2013 water use. Looking at the 2021 drought, the more recent drought, basing off of 2020 usage, right? So that more recent baseline water use year, we see an average savings of about 11%. So almost half the amount of savings that we achieved during the previous drought, the 2014 drought. We can see a seasonal pattern here, and we'll see another chart showing that as well. But this is starting in January in both charts. So as we see these summer peaks, we're seeing more savings occurring during those summer months, which is what we'd expect as the biggest opportunity for water savings is by reducing irrigation. So that's definitely what we saw during both of these droughts. But I think even more notably during the 2015 drought. And yeah, notably, as I said, the drought savings we achieved are a lot lower in the more recent drought in 2021.
But Drew, do you think some of that could be accounted for that 2020 was just an odd year? Because you had that uptick in use anyway, so you're starting for like a higher baseline?
I mean, I think that definitely affects the water use trends here. I do think, in this case, even accounting for that increase water use in our residential use, comparing that to our drought use, you would expect even actually a greater reduction of water use during the drought. So, I would say if this did not include those wonky COVID numbers, this percent savings would probably actually even less during the drought because we don't have that, elevated residential use. But yeah, you're right. That's certainly affecting those numbers here, but I think it's actually, showing more savings than is maybe realistic because of those elevated residential water use in 2020. Okay, yeah, next slide. So this is basically comparing what we achieved, those percent numbers to the savings targets that were basically either volunteered or mandated by either the state or San Francisco, the regional water system. Looking at the 2014 drought, there are basically two targets that were set. The first one was a 20% water use reduction at the beginning of the drought, and then elevated to 25% later in the drought. And what we saw is that the average achieved savings that we got during that time period was not quite hitting that target of 20% in the beginning, but then actually overachieved and saved more water use than what was called for by the state towards the end of that 2014 drought. Looking at the 2021 drought, we see kind of a similar pattern. There was a call for a 10% reduction. Our average savings was about 8.6. And then, increased to 18% during that, when we elevated into level 2 water shortage, the 10 to 20% water use. So, we're within the called water shortage, water use, cutbacks. Basically what this is showing is that, we were able to achieve those, either voluntary or mandatory savings that were imposed by the state in both droughts. But, were less effective during the 2021 drought, than in the previous drought. So, showing that we can achieve those targets if we need to, but, the concern there is that we're getting less able to reduce that water use, in this more recent drought. So, yeah, next slide here. This is, I think, oh yeah, so just another look at the comparison of water savings during these two droughts. The darker blue line here, the 2014 drought, and then 2021, the lighter blue. Basically showing the amount of water demand reduction, based off of those, baseline years. And what we see, clearly is that the amount of water we reduced in any given month during the drought, was far greater by, anywhere from 10 to 20% in the more recent drought compared to 2014. Okay, and then this last chart showing here the monthly seasonal demand. So this is basically looking back through 2013, and looking at the monthly water use. What we see overall trend is that our water use is higher during the summer, which is typical and expected, right? We know that more irrigation happens during the summer, so we're gonna expect more water demand. But then we can also see a greater difference over years between these seasonal uses, comparing to summer and winter months. So if you see here in the middle, these summer months have a much larger amount of water use in previous years compared to more recent years, whereas winter months are more flat relatively, so that there's a less variation and change during winter months than we see during these months. So basically showing that, we've been conserving a lot of water during the summer for that irrigation use in recent years. And that's really where a lot of our savings are coming from. Okay, so that's kind of like broad overview of like how we performed during these recent droughts, and kind of what we're looking at and what we can potentially expect for future years. Just to give a broad overview of those who aren't familiar with the water shortage contingency plan. It's a basic plan the document has that establishes guidelines for how we operate during a water shortage. Typically that refers to during a drought, but that can be any sort of water shortage. If there's a earthquake or something like that disrupts our water supply. This outlines different actions that we can take to ensure that basically our customers don't run out of water. That's essentially the goal of the document. The most recent one was drafted in 2021, and are starting to and will be updating the plan for 2025. These are required to be updated every 5 years as part of state water resource control regulations. And will be in conjunction with our urban water management plan update as well. So this is undergoing, and it will be due by July 1st, 2026, so July of next year. As part of the plan, among other things, it basically establishes different water shortage levels for the district, and associated demand reduction actions to basically help us achieve those water reduction goals. So it ranges from 0, which is no anticipated water shortage, all the way up to level 6, which is greater than 50% expected water shortages. And they each have different descriptions, and then, like I said, different demand reduction actions that are associated with them. So we go to the next slide. This just shows some examples of the reduction actions that the district can implement depending on which stage we're in. So stage 0 has some just like baseline actions that we have, such as requiring shutoff nozzles on hoses. It dictates different time of day that people can irrigate and days of the week. And as we increase this shortage level, the demand reduction actions get more and more stringent. If we go all the way up to level 6, that most extreme example, it will include like shutting off non-essential water services, stuff like that. So it is, depending on what stage we're in, the level of severity is going to increase. And I should mention, that they are all, all previous actions are in play as you increase the stage. So if you're in stage 3, all stage 0, 1, and 2 actions are also in place. Okay, so, Kat kind of mentioned this already, but, basically since 2023, since coming out of the last drought, we've been in level 1, in stage 1 of our water shortage contingency plan, essentially asking customers to reduce up to 10% of their water use. The reasoning for this was that we want to encourage responsible use of our water to our customers. And we want to be able to have certain triggers to implement if we need to say, okay, we can implement these different actions to help encourage customers to save water. I think some of the drawbacks to that approach are that, I think the main one really is that customers start to get drought messaging fatigue, which is basically when you're inundated and shown, you have to conserve water, you have to conserve water constantly, they start to not value it as much. They start to think this is not that important. We're always told to save water. It just doesn't matter. So that when we actually are in a drought and we really start to need to make those savings due to, mandated shortage responses from the state, the customers just aren't able to respond because they've been so inundated with, okay, we have to save water. So I think that's one of the main, fears and risks of staying in that level 1 elevated shortage level is that customers just aren't going to be able to respond during a drought when they really need to save water.
And that's really, what the data he presented shows is that our drought savings comes almost entirely from the residential sector. And almost all of that comes from irrigation. So as our customers convert their lawns to more efficient landscaping, as they tweak their irrigation, get smart controllers, all of these things that are wonderful and we do appreciate, we do want them to do, but the reality is each subsequent drought, it gets harder and harder to achieve that savings. We're squeezing our customers harder and harder. And our customers respond, and that's wonderful. But every time we have a drought and we have to measure our savings, it's measured to a baseline. And whether it's the state and a baseline that they decide, or if it's SFPUC, and we've only so far had voluntary reductions from SFPC. We haven't had to do a mandatory, but if we go to the mandatory route and then we have to implement the tier 2 plan that we'll be bringing the update to you guys soon when that process finishes. But that's compared to a baseline that's calculated on recent 3 years, not drought years, right? So we're always compared to a baseline. That baseline just keeps getting lower and lower. So we need to kind of just start thinking about and ahead where that opportunity is. And so far our drought response really has been messaging and communication and asks of our customers. We haven't had to go when we really don't want to go the route of implementing penalties and other kind of draconian measures, which some agencies have had to do already. We want to avoid that. And so if messaging is our primary tool, let's not have that messaging fatigue. Let's hold back. Level 0 already prevents water waste. We want it to be, you're a good steward, you don't waste water, great. Not, we're asking you to save 10% just because. So that's kind of the distinction.
Yeah, so we can go to the last slide. Yeah, so basically, because of that reason, and given that these last few years we've had, really average or above average precipitation in this region for really the last 3 years, and this year is looking like another great year. So it's really, and we've heard from SFPC there are no anticipated water shortages coming up for the summer. So we are really not, anticipating any need for water use reduction or voluntary measures, anything like that. And given that, even though the district was able to meet those voluntary targets during the 2 most recent droughts, there is fear that the customers are getting, as they get more and more efficient, it's going to be more and more difficult to meet those targets. So and I will just reiterate, being out of level 1 does not mean open up the taps, just like use however much water you want. We still have measures in place and we can still emphasize responsible use of water while also not asking the customers to, reduce up to 10% and burning them out on that messaging. So, for those reasons, we're recommending that we, remove ourselves from this level 1 and then implement level 0 of our water shortage contingency plan. Yeah. I think that's all I got. Yeah. No questions?
Nice
So-
job, Drew.
Thanks.
So getting back to the 10%, I mean. Yeah, if we ask our customer to reduce by 10% and we do that, 10 years in a row, obviously. That's a lot, but 10% in reality is not that hard to achieve, 10% reduction.
Well, this last drought, we achieved 11%. And that was with all the drought messaging, right? And that is compared to the 2020 COVID baseline, which was an elevated baseline. So as we move forward, 10% is gonna be harder and harder to reach.
Because you already cut the 10% from the baseline before.
Yeah.
So this will be, exact, this will be the 20% from that baseline. Yeah, of course, and then it becomes a lot difficult to do, yeah.
Yeah,
Mhm.
and we don't get to choose our baseline.
Correct, yeah.
And how does that fit in with our rate structure? Because we put a drought rate premium number into the
Yeah, and
rating.
that's another aspect that I have a hard time wrapping my head around, and, if I was asked to explain it, I would have a harder time explaining why we have a rate stabilization factor for a level 1 shortage. If we're always declared to be in a level 1 shortage. So
Right.
what are you stabilizing if this is your norm?
And in fact, we are not.
And we haven't
using that
implemented it. We
rate.
haven't implemented it. We've never implemented it, but it's a tool that we do have available.
Right,
But why does the tool exist if this is your norm?
exactly. I mean, it's sort of, okay, then we should have set the rates for January based on that norm. And it starts to become difficult to say why it's there.
And a similar question is, why do you have a level 0 water shortage stage if you're never at level 0?
Right.
So I think this idea is just kind of resetting, kind of conceptually what it is, and as, Drew starts updating the water shortage contingency plan, we've talked about how we want to frame and describe each of those levels, knowing that so far outreach is our biggest tool and has been our biggest tool, that is always our go-to. So if we frame those levels in a way that really communicates the need and the severity, a little bit more thoughtfully, even spend some time kind of pre-developing outreach materials and messaging now when it's not a drought, when we have the luxury of time to do so.
Mhm.
That's the approach we want to take. To always do that first. We obviously have the sticks that, we have available to us if we need them. But we'll focus on messaging, and this is one part, the first step with that messaging.
So rather than talking about conservation as a goal, it's more best management practices
Exactly.
as our normal practices.
Yeah.
And so we don't have to say, oh, we're trying to conserve 10%, we're trying to use water wisely.
Yeah.
Okay.
It sounds like you almost off the record want a little higher baseline when the drought does show up. So,
Well, it's not really that. It's more, people should not have to be going out of their way not to use water in time when the system has plenty of water. I mean, it's like, okay, I still haven't gotten around the idea that I can just, waste water down the sink when I'm waiting for the hot water to make it to the sink type of thing.
Well, and when we do public outreach events, there's always customers who come up and they're like, yeah, I'm saving water all the time. I still have a bucket in my shower and I do this and I do that. And they're going to these extreme measures that, again, really appreciated, love the enthusiasm, love the dedication, and they're just, they're wonderful community members, but it's also not necessary. Because in wet years, we have enough in storage, there's water. I'm not saying it's waste, and that's a whole can of worms with the kind of environmental side of things, but. There's water that's going out to the ocean that the system has available to it.
Yeah, but those people are making up for those who only save 1%.
Yeah,
Yeah.
so that, a few gallons that you save from your shower bucket. You don't need to.
Yeah, but we're
If
not
you wanna
gonna,
do it, great, but you don't need to.
yeah, we don't need to, but we're not gonna discourage it.
Yeah.
We're gonna do it.
And we always have our conservation rebates available to the public, like regardless
Yeah.
of drought or not, so. I get calls, at least weekly about, wanting to participate, so I think the culture is there that people are already, thinking about using water wisely.
Of course,
Mhm.
yeah, yeah.
And if they wanna take advantage of our rebates, that they're always there for them.
Right. But I mean, you start going, well, if you put a bucket in the shower, it's fractions of a penny. That you're paying for that bucket of water type of thing.
Yeah.
And so it makes no sense to really do that.
You're paying more
Other
for the
than-
bucket.
Pardon?
You're paying more for the bucket.
Well, I'll talk
We give them
about
out.
what we gave them.
Yeah.
Oh, okay, you can reuse the bucket.
But it makes him feel good.
Yes.
We have a bucket and a
And
20-minute shower that my wife takes, so I always have that conversation. Just because you have the bucket doesn't mean that, you come back on the shower 30 seconds, you have 3 buckets that
That's
you've,
right.
Yeah.
The same.
that are saved, so.
Yeah.
I'm jolly Harry that you just brought that.
I- She's in Panama.
No.
But this is.
We are recording.
She's watching right now.
One attorney to another. You guys have a code, man. Oh, boy. Thanks, Julie. Okay.
So,
Good job, Drew.
Thank
Yeah.
You did.
any other discussion about the actual measure that they would? Because we have ordinance 130. But I have ordinance 126.
130 follows immediately after the staff report. 126 is the old one that's getting would get rescinded by 130.
Oh, wait a minute, I signed that one.
The one that will be superseded.
Okay.
So, Joanne, you wanna offer?
Yes, so I move
Ordinance 130.
approval, what do you want me to fill thing? Okay, I move approval of ordinance 130, an ordinance rescinding level 1 and authorizing level 0 water shortage response of water shortage contingency plan.
Okay, I'll second that.
Thank you.
So it'd be a roll call.
Roll call.
Director Covington,
Yes,
Vice President Bella,
Yes.
President Wheeler.
Yes. Thank you. Thank you, Drew.
Thank you. Yeah.
Okay, so. C8C. See the report and provide preliminary direction on fiscal year 2025-26 water rate adjustment. So that's gonna come up in June.
Well, the rate adjustment would go into effect July 1.
Right.
And so, we're starting to think about it now and what it looks like. SFPUC, we've talked about, they gave their kind of initial range letter, and I think it was January, and then in February, they had their wholesale customer meeting where they showed kind of the next 5 years, what they were planning. And then they actually, earlier than they did last year, they did provide their kind of final letter saying that their wholesale water rate increase that they're presenting to the commission is going to be up to, will be $5.80 per CCF. Which is 1 cent higher than what they said at the wholesale customer meeting. That'd be
Pretty
2 point,
close.
yeah, yeah. So 2.3% increase. That would be effective July 1. And so, you know, it's not official until it gets approved by SFPUC, but SFPUC, I believe, if not almost always, I mean, we expect them to follow staff recommendation. They don't tend to do anything too surprising. So, fairly confident that that's what'll get adopted. This increase is 6 cents less than the rate for this year, the SFPC rate for this year that we included in the 5-year rate study. And that was based on prior projections that SFPC gave us. So it's a 6%, or sorry, a 6 cent savings. That because that's a pass through, we pass through that same 6 cents savings to the customers. So the next section shows what those water rates are with that 6 cent savings. From the water rate study. So because that was passed through Prop 218, the board can elect to increase rates up to the amount shown here. You can see, you know, with the adjustment, depending on which tier it is, you know, it's a 4.4 to 4.7% increase on a metric basis. So, you know, knowing that those are our bounds and what we're looking at, and, you know, this time of year, we're starting to look at and think about the budget for the next fiscal year. Starting work on that, and so kind of as a first phase, we're doing some pretty high level assumptions regarding next year's budget that we're still working to refining, going line by line for the budget to adjust, but, you know, kind of hit all that major high point items. We also looked at the CIP budget update, which, you know, we changing a little picture now that we actually have the COP that's final. We know what the actual payments are gonna be and interest and all of that. We, you know, have a couple of updated cost estimates, like the updated Folger estimate that's included. And some adjustments, so we looked at that. And then, James, if you wanna talk about the cash flow analysis, all of that rolls into.
Yeah. So,
Before you get to that, I'm a little bit confused because we are already scheduled to have an increase in July 1. That was part of the resolution we've already
Yeah.
passed. So these numbers that you're talking about, the 6 cent savings, are separate from that?
So we don't have to raise rates. We could,
Yes.
the board could elect. So the numbers here is what is shown in the rate study minus the 6 cents, because we have an SFPUC pass through, their rate increase was less than we expected. So our rate increase is gonna be a little less, or our maximum rate increase will be less. That same 6
6 cents less.
Well, all of them were estimates. So the Prop 218 numbers are just place a limit on how high we can go. Okay. And so
That ceiling is
it's a
wrong.
question of, we're either using the old projections, or we're using this actual number and supplementing it with another actual number, which James is then going to talk about.
Well, am I correct that we have to pass on that savings for the SFPUC portion of our rates?
Correct, just for that 6 cent savings.
Okay,
So our ceiling is just lowered by 6 cents. And then you
okay.
can do anything within that.
That's what I was misunderstanding was, okay, that is a required aspect. Rather than just, we can do whatever the number was that was in the rate
For
Sorry.
that, for that
for that
particular,
particular.
line.
Rate increase, yes,
yeah,
the July 1 number, okay.
And so our goal here is to see, you know, obviously, it's not that long since the rate study was done. But certainly we want to do this every year, but we've had some major changes like the COP, et cetera. So we want to make sure all of the assumptions that we had made then they still are true and apply and, you know, question whether or not our revenue needs, support that rate increase or consider something else. And
Okay.
so, that's the purpose today, is to present that to the board, get any feedback so that we can, you know, take action when we need to affect that July 1.
Right.
Um,
And that recognizes that we made some fairly conservative assumptions in the rate study about what the cost of inflation would be over time and various other things in those rates.
Yeah.
So that, but it 6 months, so it can't be too far off. Yeah.
hopefully, yeah.
Okay.
Yeah. And, you know, we'll do the same thing next year and the next year. I mean, the farther out we go from the
Yes.
Yeah.
We
rate
have
study, things
the,
will change more.
we have the opportunity not to raise it that much each time as we get farther out. Yeah. Okay.
And can you remind me, the January rate increase? We did that in January, but we did not do a rate increase in July of 24.
Last July, we passed through the SFPUC rate increase only.
Okay.
And I forget what it was, but say they raised it 10 cents, we raised ours 10 cents at each tier. But that was the only change, and it was just the direct pass through so that we and our customers are made whole by SFPUC's increase.
Okay. And the January rate increase,
The January rate increase averaged over 20% across the board, and that included both the projection for future SFPUC rate increases and something for us for our long-term debt service and the fact that we hadn't had a rate increase to cover our operational expense increases over the past several years. Because we had delayed having a rate increase for 5 years.
okay, so typically we would be doing rate increases in July of every year.
Yes.
And January was a one-off sort of catch up.
Yes,
Yeah,
because
That's
we
the-
finally got the rate study finished.
Got it.
Yeah.
Okay, thank you.
and just to point out, so the last time we raised rates for our purposes, not just the pass-throughs, was 2019. And over that time period, the CPI increased, it was like 19.7%. So, you know, yes, it was a large increase, but there was also that time that it's also covering for, as well as our look ahead revenue projections, so.
Okay.
For needs.
So the lesson learned would be that, I mean, the pass-through will have to be applied, pass-through is the pass-through, but we should not wait that long to do at least incremental, small increases, because otherwise, and we know that many other agencies got caught with this and they had to do really, really massive increases to catch up.
But there,
So we were not,
everybody's gotten caught because SFPUC had a long period where they had a bunch of big increases all at one time to fund their major capital program.
Mhm.
And then they had a period of what, 4 or 5 years where they basically
Yeah.
had no increase.
and most agencies elected to kind of absorb a lot of those so that they will not increase to their constituents.
Right,
Yeah.
But then it caught up with them, and it caught up with everybody, you know, so.
and it caught up with us, but not as bad as
Not as
some other
much,
agencies.
not as much with us, yeah.
Yeah, okay, thank you for that background.
And, you know, just to kind of, to your point of, we should always do, you know, small increases, so. Our ability to set our rates is governed by Proposition 218, so we have to do that within the bounds of Prop 218. But as I learned maybe a year or so ago from actually Allison Schutte and Hanson Bridget at one of the WMR meetings. There's a mechanism to do a pass-through for, you know, SFPUC costs, there's also a mechanism to do a pass-through for just CPI. So if we're ever in a case where we don't feel the need to, or we can't do a full rate study, which is a big effort. It's a very thorough study. We can elect to do a Prop 218 process to allow for the pass-through of both SFPUC and CPI costs
Yeah, yeah.
to kind of bridge whatever period we feel we need to.
Okay,
But that would be separate from the 5-year study?
We wouldn't need to do that until after the 5-year study,
Okay,
but.
Yeah, so it's something we could have done because
Yeah, and that,
our
would-
5-year study expired 3 years ago. And we got caught not being able to do it because COVID meant that all of the projections were going to be impossible. We
Yeah.
just didn't know how to project them going forward.
Understandable.
So that's why a lot of other agencies are in the same position.
so the CPI increases will keep us in compliance with up to 18.
Yeah, you still have to do a Prop 218 process, telling your customers and, you know, seeking input, but that, yes, we're gonna pass through CPI.
CPI numbers would not get us anything that would pay for an increased capital.
No.
Yeah.
So that you won't get caught,
Operational.
yeah, so you won't
expense
get caught
increases.
up, yeah, exactly, yeah.
So one of the things that we did, in order to determine the need, if we need to increase the rates beginning in July, or you need to consider that as we did a cash flow analysis over the next 5 years through 2030. We do have some estimates for beyond, but purposes of this, it's just focused on 2030. And we compared basically what our cash reserve would be, we're estimating what it was as of July 1st this year, based on our mid-year budget. And then calculating what our reserves are gonna be for those future years based on our spending for capital, both on the COP side as well as PAYGO. So when you look at that cash flow analysis through fiscal year 2030, you'll see next year our debt service ratio does drop down to 1.5. So we have a required debt service ratio of 1.3. One of the things that we determined with the main impact was what's the study name? The transmission line assessment study, which is approximately $625,000 that we had budgeted for this year and we're rolling forward to next year. So we're not gonna see an impact this year, but we will see the impact next year. The other impact that we'll see next year that's skewing the ratio for at least the first year is we're going from about $1 million, a little over $1 million in debt service payment to over $2 million debt service payments on an annual basis. 1.5 this year, 2.8 for next year. So those things are kind of skewing the ratio for that first year. When we're looking, and this cash flow does take into account that we are doing those increases in the future years. So when you look through this and you look at the next page, you'll see that based on our PAYGO capital that we're gonna be incurring over the next year or two, our reserves will drop to just about where our target working capital is, our working reserve or operating reserve. And that's our first reserve the highest priority reserve that we have, is our operating reserve, which is 50% of our budgeted expenditures. So we do get close to that in 2027 based on that capital spending, but then we start to build that back up. But we never really want to go below that. Our cash balance never really wants to go below that number.
And this picture, this is why we made the graph look very similar to what you saw throughout the rate development process.
Yeah.
But this is very similar to what we did project as part of the rate study. We knew this first year would be a hit. If you remember, the rate study assumed we'd do a COP, 2 rounds of COP financing. And so of course, we were looking closely and a little concerned, how does this change things doing the 1 instead of the 2? So, it's similar, it kind of kisses the line. Well, we did a monthly breakdown there, but it's something that, and we'll keep a close eye on. For purposes of reporting to the COP though, we only need to calculate the debt service ratio on an annual basis.
Right.
So getting close or even below for a month, is not.
Right, which is why we didn't show it by month, we just showed it for the annual.
Their annual basis is in December.
No, it's fiscal year basis. So
Our fiscal year.
we're able to manage it on a fiscal year basis, yeah.
Okay.
The other thing to note is, you'll see in 2030, we start creeping up towards that blue line, which includes all our reserves. That includes working capital for operating reserve, capital reserve, rate stabilization reserve, debt service. So we want to make sure that,
over the next 5 years, we're slowly getting to that 1.2 rate stabilization reserve is the lowest priority reserve that the board has identified to fund. On the third page, we show that projected COP fund balance. So basically, one of the things that we were talking about when we were talking about how much to fund for the COP is whether or not we're gonna be able to spend it over the next 5 years. Because that is, as long as you've got a good faith estimate, to spend it over the next 5 years, you're less likely to get arbitrage or hitting any of the rules or whatnot. And you'll see based on the projected COP balance, we're good to go with spending in the next 5 years. So, we can spend it down real quick as long as Juven can get those projects online.
And, the reality is we plan and we put our best guess on
Yeah.
a monthly basis what those expenditures will be.
Yeah.
But projects get delayed. But what this shows is even if they do get pushed out somewhat, we're still,
Yeah.
within that 5-year time frame.
And
And
also, this is showing that we're not actually going to be spending COP funds until fiscal year 2026.
well, it's just starting at fiscal year 2026. We've actually already spent some funds.
Yeah.
Right.
Mostly architect costs, but that we'll be able to reimburse ourselves from the COP funds we can.
Right.
So,
We were expecting about 400 and some odd thousand for this year, for this fiscal year that we didn't include in this chart, but this actually starts at that revised balance of about $32 million, expecting that we've already spent some of those funds.
Okay, so that's for the year starting
July 1st.
July first,
Yes.
2025,
Yes.
Correct.
fiscal year 26.
Yep.
Okay.
Next chart reflects our current CIP, what we're gonna be spending those funds on. And you had built in 5% for the
4%.
4% for the cost escalator.
Yeah.
So
So that's in there, and then also, I don't know, you mentioned for the COP, assuming 2.5%.
yeah, so, part of the balance on that first page, when you look at the beginning and ending balances, you'll see that total inflows interest earnings. I was expecting about 2.5% of interest earnings on whatever we haven't spent. So, and I calculate it on a monthly basis going forward, so. So we are taking that into account when we're projecting the spending for the CIP projects.
We should do better than that, though. Based on your.
Yeah, I was trying to be conservative. I didn't want us to target to spend money that we didn't know that we were gonna have, and interest rates can go from, 0.4% that we saw just before COVID, up to 6.25% that some funds are realizing now. So annualized, we can't go above 4% because of arbitrage. So we have to actually maintain our investments lower than that. So, I just projected 2.75% on an annual basis.
Yeah, and our ladder system was getting us something like 3.5.
So our ladder system's getting us just a hair over 4%.
Yeah,
But those are not COP funds. Those are.
yes, that's all
Yeah,
of our.
those are operating funds, yeah.
And when we do this type of budgeting and projections, we never wanna have rose-colored glasses. We
No.
always wanna choose
Yeah.
reasonably conservative.
Mhm.
We never know worst case or anything, but we, yeah.
I mean, we can, if we get higher interest earnings, we can buy oak door for a Folger, right? So.
Or do more projects.
Or
'cause
do more
remember, we have
projects,
that
right.
Yeah,
CIP
we
with
we don't have a shortage of.
tons of
Yeah.
needs, so.
Yeah, projects.
I'm sure Jim can get creative and find another CIP.
No,
project.
I don't even need to create, we already have
Yeah.
a list of
We've got a
90
list of
projects.
$90 million.
Yeah.
Sort of thing, yeah.
I
You know,
like the
and-
conservatism. I don't want to complicate anything, but I was just remembering what Bob was saying at Wolf Hanson, that they look at the arbitrage rate over 5 years.
Mhm.
So.
So you have to make an evaluation of arbitrage every 5 years, and potentially remit some of that money back to the IRS if you do make above that arbitrage rate. But we want to make sure that you make that evaluation on an annual basis, just to see, kind of do this, okay, are we close, or, what's happening? Especially for financial reporting purposes, because then you have to record liability if you're above. So
Gotcha,
we
okay.
want to make sure that we're staying within the realm of reasonable returns.
Yeah.
Right.
So, but below
And-
what we're spending.
And as I remember it, his mechanism for fixing that was to spend more money, move those capital projects
Faster, which
Yeah.
looks like we're doing.
Yeah,
Yes,
Yeah.
we have a very aggressive schedule.
yes.
Yeah. And, you know, kind of on that note, we have an aggressive schedule for all the projects we have identified. But if you look at the bottom of this table, we have both pay-go basis and, you know, debt finance basis. About $14.5 million worth of projects for projects that have not yet been specifically identified. For projects that are in our CIP or any other new needs that we identify and add to our CIP. But that gives us flexibility, which I am at this point in time very grateful to have as we see whatever happens with markets and materials costs and everything. So, you know, it gives us, you know, some buffer if we see increased costs for the board to make those decisions, to go ahead and cover those or, you know, whatever decisions at that point, but, and hopefully gives us money to do more projects that we haven't yet identified.
Just a quick question. I want to make sure I'm reading this annual cash flow. The total outflows capital projects. Like looking at FY 2026 of 14 million, that includes the pay-go line that's.
No, that's purely on, from the debt financing,
Purely, okay, so our total outflow for all capital projects, who Vaco, I'd have to.
about
pay-go, I'd
22
have to-
million.
20, okay, got it. Thank you.
So altogether, looking at all of this, our recommendation is, you know, based on the cash flow analysis, the near-term pay-go capital expenditures that we plan, on spending, how close we get to the debt service ratio. And of course, all the trends towards inflation we're seeing, our recommendation will be for the board to adopt the full rate increase identified above and not make any adjustments other than, of course, this SFPUC pass through. And so, you know, unless there's any input or further questions from the board, our plan is to bring this recommendation as an action item in April. That will give us plenty of time to do the customer messaging we need to do. We have a 30-day notice that we have to give customers before we implement an increase. It's not a Prop 218 process where they protest. It's just a notice saying we're going to do this. We could, in theory, do it at the May meeting. It's May 22nd, which is early in the month, which would give us kind of just enough time to get that 30-day notice out. But if there's no reason to delay, we might as well take action in April and have plenty of cushion to do that. So the point today is to see, you know, seek your input, get your thoughts. See if there's any further analysis or anything you'd like us to do.
So. I'm not seeing anything in this that says that we should reduce the amount of the potential increase. That's my reading of your report
Yeah.
is we're close to the debt service.
There was nothing in my reading of the information that
Right,
led me to that conclusion either.
okay. And the more money we bring in early in this process, the better off we are, no matter what.
Yes.
Coming, you know, saving a percentage point now. And then turning around 4 years later and saying, oh yeah, we could have had an extra $1 million.
It's harder to recoup later what you can get now, yeah.
Yeah,
And that also targets the reserves that the board has directed us to fund.
yes.
So that also helps with that funding piece as well.
We're not getting our full reserves back in 5 years, we didn't, that
No.
wasn't our expectation. It would be a while afterwards.
But we want to make progress towards it.
Yes. Yeah, particularly the operational reserves. Okay. Any comments, concerns?
I have anything further?
Okay. So you have sufficient direction?
Yes, we will put it on the April agenda to approve the rate increase.
We've got one of an actual number to stick in there.
We should, it should be that,
Right.
like presented there, because unless there's any big surprises from SFQC, that'll be the number.
Okay. And then. The. You see a report on the. Regional water system.
No, it's not D. I got my report in on F and the agenda changed a little bit, so.
Okay, so it's F.
Yeah,
I wish nobody
F in the paper.
tracked that for us and adjusted it, but it's an easy one
No,
to miss.
that's fine. Okay. Ready?
yeah, so the monthly, the water supply report, just some charts and information. So this first is a US drought map. And just pointing out that, you know, west of the Mississippi, we can see the drought coloring starting to populate, you know, that part of the US more and more. You know, they have the exceptional droughts down in Texas near their panhandle down along the Mexican border. But what's interesting to note is the exceptional drought, the D4 level is starting to creep into California again. So if you go to the California map next, you'll see that in that very bottom corner there along the Colorado River area, the exceptional drought. And I was looking back when the last time California had a percentage of its, you know, land area in the exceptional drought, and it was back in December of 2022. So it's been a long time, right? December 22 and early 23, we had all that rain and it just kind of wiped out, you know, the California map was white for the longest time, and slowly over time, yeah, the drought's creeping in, and especially in Southern California. I was taking a look again at information last year, and some of it you may recall that in the fall of 23, Southern California had this monsoon rain that came through, and they had like a whole season's worth of rain in one rain event, and it just lasted them. Well, this year, you know, they haven't had anything, or it's been very little rain. You'll see that in one of the tables that I have in here as well. So the drought colors are starting to show up in Southern California. Northern California, where we're at up here, we're all still looking pretty good. So how are the reservoirs looking statewide on the next slide? They're all looking really good. You know, all of them, I can't, you know, there's only one that I see, Millerton, or actually Millerton and Castaic are slightly below their historic levels for this time period, but everybody else is at their historic levels and or above them. The Dom Pedro, which is where the SFPUC has their water bank, is at historic levels. So right now going into, you know, snow melt season, the reservoirs are looking pretty good, and it goes along with what Steve Ritchie from the SFPUC is saying. You know, they're looking pretty healthy reservoir wise. You'll see that. And from what they're seeing, even though there hasn't been a lot of snowfall, a lot of rainfall in the upper countries and the watershed, you know, there's sufficient storage that they're pretty comfortable that there's probably not going to be any calls for reducing water in the regional water system. The next slide is the rain totals for select cities up and down the state through March 4th. And so again, if you look from like Bakersfield south down to Palm Springs, you'll see in those first three columns of rain data, they're showing that there's just been very little rain compared to what they would normally see up in that time period. You go into Northern California, San Francisco, downtown and the airport, we're almost at normal, you know, 99%, 92%. But the more you get into the middle of the state and south, Fresno, Bakersfield, and then especially down south, San Diego, the Montgomery Field and Palm Springs, just well below where they normally are for this time of year. And then again, on the far right side, you look at where everybody was last year on March 5th, 2024. You know, the rainfall was well above normal. Mother Nature is a tricky thing. Not always consistent. In terms of the precipitation outlook from NOAA, this map that I pull off here, basically NOAA is predicting for the months of March, April, and May of 2025 that we're gonna have equal chances of having either above normal rain, near normal rain, or below normal rain for our part of the country. But then you can see again in Arizona, New Mexico, and parts of Texas, they're predicting low, which is not good. I mean, you've read some stories too, that there have been some wildfires in the Plain States, which I'm not sure I've heard too much of that. We hear wildfires here in California, but the Plain States have had some wildfires. I mean, I remember hearing or reading one, it was like 170,000 acres that burned, you know, which is pretty substantial. And then even here, last week, I heard that there's some wildfires in the Carolinas, which you just don't always hear a lot about. And they have some drought, but not the type of droughts that we normally hear on our part of the US. In terms of temperatures on the next slide, again from NOAA, their models are saying that for the months of March, April, and May, that again, we're gonna have equal chances of above normal, near normal, or below normal temperatures. And it's kind of been like that, right? Earlier this week, it was pretty warm in the Bay Area and other parts of the state, and last week it was kind of cool, and even today it's you know, kind of not too bad, kind of cool. So I guess it's, you know, equal chances of kind of being all over the place. The next slide is the precipitation up in the Hetch Hetchy watershed. What was interesting here is last month we reported out, we're getting into February, you know, we were well below, the red line was well below the 30-year median. And then in February had some pretty good rain events that brought significant rain up in the Hetch Hetchy system, and it right in the middle of the month, it caught up with a 30-year average or median, right? And then it just tapered off. There was no more rain up there. So then that red line stayed flat. But and when compared to the 30-year median, we're falling below the 30-year median. And I imagine so far in April, there's been some rain, and we'll see if, but not anything significant. We probably have a couple more months of rain in California. We'll see how that all pans out. This next slide is from Mr. Ritchie's presentation, the SFPUC, the Upcountry 6-Station Precipitation Index. So currently, they're at 63% of their median total for the 12-month total. And you know, what's interesting is, you know, the rain year starts in October, and the Upcountry kind of mirrors what happened here in the Bay Area. They had a dry October, a wet November, a fairly wet December, and then a dry January, then a wet February. And so far at that time when I took this slide, March was, you know, just starting to show some rain. It'll be interesting to see how much rain they got up there during the month of March when we see the information update next week at the water managers meeting. And then on the next slide, again, looking at the Bay Area, the same kind of bar graph, where the Upcountry was at 63%, the Bay Area, we're at 77% of normal. And as I mentioned, you know, the October was pretty dry here in the Bay Area, and then November, December were really wet, and then January is really dry, and February really wet, and March kind of came in with some rain, but I'm not sure if how much it panned out into being a normal wet month for March. And then going to the next one, which is the Upcountry snowpack. How does that look? This to me, it reminded me a lot of the Hetch Hetchy precipitation line graph, right? You had the 30-year black line, the median. And when we came into February, that red line there, it was well below that 30-year median. And then with the rain that we got, it also translated to snow in the Upcountry. So that red line started to climb again, very similar to what the precipitation line did. And then the rain and the snow stopped, and it just the red line just kind of flattened out, and it just stayed below the median. The next slide is the regional water system storage. Again, this is information that the SFPUC folks provide to us, and I just add a couple more years just to provide some comparison, but we're looking pretty good. Overall, the regional water system storage capacity is at 88%, or about 1.3 million acre feet. Last year, at the same period of time, we're at 1.37 million acre feet, so 93% full, so a little bit less than last year, but still very full. But when compared to February or the end of or beginning of March 2023, a little bit different picture. The total storage back then was a little over a million, or almost 1.1 million acre feet, or 74% full. So, we're sitting really full. We've got a lot of water stored. I think the SFPUC finished their winter work on the system, so now we're getting water back again from Hetch Hetchy and not taking water from the local Bay Area storage reservoirs, and that typically then is fed through their large surface water treatment plants in the East Bay and then also north of us at the Harry Tracy plant. In terms of total deliveries in the SFPUC system, tracking, the information shown here, the green line for calendar year 25 showed during the week of February 19th, 25th, which is the day when I pulled this, the average delivery throughout the system was 160 million gallons per day, which is a little bit less than the 5-year average, the yellow line there. But above calendar year 24 and calendar year 23 at that same period of time. And so what's interesting here is, again, ours is kind of similar. So the next slide is our water district. And so what you'll see here is that the information for February, at the end of February, the water use in the community here is very similar to what we saw not only in 24, but also in 23, which is kind of similar to what we saw in the regional system. We're starting to get into the water season, and we were talking about that when Drew and Kat were talking about the water shortage contingency plans. We'll see how it plays out. It just as it warms up, and if it gets warm this year, I just can imagine people using more water in the summertime than they probably have in the past few years, because we're not experiencing a drought. And I think as long as the PUC says that there's not going to be any water shortages and not going to be asking us to ask people to do it, we're going to see people using water, wanting to use water. Couple more slides, cumulative water, this line here. So you can see that the green line, you can barely see it, but it's just slightly below the 5-year average, which again, we're talking about how people we're only gonna be able to squeeze so much water conservation out of them. And here what we're seeing is right now we're tracking below what the 5-year average is for our water demand on the system. And then the last slide is just the fire potential. And this one, it just amazes me how good these people are at tracking this data and then, showing where their danger is, and then all of a sudden the danger pops up, right? Again, this was taken, it was valid for Friday, March 14th. And around that time period, you started to hear about some of those wildfires in the Plains area there in Texas and Kansas and so on. And then further to the right, where you see the tan areas, those are the Carolinas, and there were some wildfires in those areas. And fortunately here on our side, we still have a lot of green out there just because it's winter for us and usually a period of low fire potential. But that'll change, I suspect, in the summertime as things start to dry out and we see more and more drought conditions. The area is increasing in our state. So that's the regional water system. It looks good. We don't anticipate any water reduction requests from the SFPUC.
Sounds good.
Yeah,
Thank you.
yeah.
Okay, management reports. Treasurer.
That's me. All right, so February, all right, so for February, we've realized the first month of the water rate increase. And with that, we're at about 72% of our budgeted figure, our updated budgeted figure. So right now we have received approximately $8.4 million in just the water rate, water commodity charges. Overall, our revenues were at 68% of our target, and our target is actually 66.67. So we're about 8 months into the fiscal year, so we're at about 67% with, so our revenues are trending just above where we need it to be. Our expenditures were at 60%, so those are trending just below where we need it to be, or not need it to be, but at the max where we want it to be. So we're doing well on both aspects, a little trending higher in revenues, trending a little bit lower in expenditures. The investment income is basically trending exactly where I was thinking it was gonna be, averaging at about 4%, particularly for the UST bills. And then the T-notes they're about a little, they're averaging at about 1.5%, is what our coupon rate is, but we did have to buy them at a slight discount, so that brings. So our average return for those T-bills are about 1.25%. Capital spending, we have spent approximately $1.3 million. Of that, 900, or about $1 million has been spent, or excuse me, 337,000 has been spent on debt financing projects that will get reimbursed at the beginning of April. And then another 661,000 has been spent on pay-go projects that, of course, that'll just get taken out of the capital reserve at the end of the fiscal year. And then looking at our investments and reserves report, so currently our working capital is at 100%, our capital reserve is at 100%. Our rate stabilization, we were able to touch on that just a little bit, but that will go down once I bring in the capital spending that we've done by the end of the fiscal year. I don't expect that rate stabilization reserve to have an amount by the end of the fiscal year because of that, but currently, as of February 28th, the two primary reserves that the board has directed us to fill are filled. Beyond that, what questions may you have?
Concerns, do you have any concerns? You yourself?
I do not at the, like, wait, what? No, I don't have any concerns. One of the things that we're looking at right now, because with the upcoming capital projects, is looking at the timing of Zion's investments, to make sure that they're rolling into our main operating account when they need to. And then determining what is the surplus that we can invest in for the next 6-month to year-long horizon.
That's for that monthly cash flow model that we have now.
Right.
Will come in very handy as we.
Especially as these, more investments come in, and then with the capital financing, we're gonna make sure that
But
gets all of.
didn't I hear you say earlier that you were involving also some of the reserves doing this, or?
So, yes, so I haven't calculated what the capital reserve
That
is
would be a
in.
concern, don't you think?
Well, we are going to stay above our operating reserve. That's my primary concern. That's the number one funding opportunity or funding reserve. So with the rate increases, that stays right above it. My other concern for next year is our debt ratio drops to 1.5. Kind of close to 1.3, but we can manage that. We can manage that 0.2 difference, as long as we're actively managing it, right? Which is why we're gonna be looking at like the investments and how everything's playing out, as well as managing the timing of certain expenditures, to make sure that we're not gonna incur everything all next year to drive that number down. So that's my primary concern, is that debt service ratio for next year. That gives me a little bit of nervousness, but I think that's manageable at this point. Yeah. Yeah, so the other thing is one thing that I noted with the cash flow projection is, with our capital projects, our capital reserve will drop to 0 at one point. But after about 2 years of mostly going over to debt financing projects, it'll start to creep back up. It'll get fully funded back within 5 years. So this time next year, you'll see it will be very, very low. But again, with the potential rate increases, and managing the expenditures, I think we'll be able to flush that out within a couple of years.
And I'll point out that while our capital reserve will drop to zero, that's at a time when we have COP funds
Right.
available, including those kind of call them unallocated funds. So if something comes up during that time period.
Yeah.
We put it in the CIP, we're allowed to use the funds for anything in the CIP, right? So, if it's, say we have a big unexpected break, that's gonna be a big project to fix, or, that's the kind of thing that the reserve is intended for. So while we don't have a pay-go basis, that reserve, we kind of do.
We still have
In the
a
COP.
backup, yeah.
So,
So what's the thinking behind letting the reserve drop as opposed to using more of the debt financing funds as opposed to the capital reserve for capital improvement projects?
It's more of, what the so we try to identify what the debt financing projects can handle, or the debt financing can handle, which projects that can handle, and then the rest falls onto the district shoulders.
and it's a little bit of a kind of philosophical decision of
Yeah.
what goes to debt financing versus what is pay-go. In general, you want projects that are gonna have really long lifespans, like the building projects, or really bigger, broader, more kind of regional impacts, like the 101 undercrossing project, rebuilding tanks. You want those to be debt financed, because that way your customers 15, 20, 25 years out are paying their share of the benefit of that project, as opposed to projects that are more similar to routine maintenance, like a tank recoating project. Those your customers today are paying for. So there's no strict rule, but that's kind of the general thought process by, which gets paid for by which mechanism.
Okay, but under the COP and the use of funds that we described and all of that, we could use all of that bond financing for everything we've identified in our capital improvements plan. Is that correct? This is more of sort of a philosophical way of how we're thinking the rate payers should be responsible.
Yeah, we have that flexibility if we need it. This, as laid out here, is very much what was laid out in the rate study and also included in the bond documentation as well. This is our plan.
Our revenue source is through the Prop 18 system. There's a certain amount of it is intended to be for capital improvements. And a certain amount of it is for operational expenses. The actual, essentially the cost of delivering water is the cost of buying water from the SFPUC plus our operational expenses to deliver it. Type of thing. And so the reserve associated with that operational expenses is sort of a baseline that we have to keep those reserves. Whereas the other portion of it is coming from a slightly different source, and we identified it that way. It's coming from the meter charges type of thing. And so we want to try to keep those two pots of money somewhat separate.
Got it.
It's not a firm requirement of anything in a lot of respects. But to the extent that our rates are supposed to be dependent on the cost of providing water in a certain manner, in order to meet the legal requirements of the Prop 218 process, we have to try and identify why we are charging certain people certain amounts and other people different amounts. So people who need large capacities pay more for their meter. People that use a lot of water pay more for their water. Because we need to have more infrastructure to deliver. Type of thing. Whereas the regular users, they're the ones who own the portion of the city, all of the capital improvement portion of the system. They've paid over the years for the capital improvements that have gone there. Like, okay. So it's really a mechanism to explain why the rates work the way they do.
Okay, thank you for that framework. That's helpful.
And there's one other source of revenue that we didn't mention during the cash flow analysis, but I think it's worth bringing up. We do, when large developments happen in our district, we assess capacity charges to those developers, and those could be substantial depending on the size of the development. They could, be easily $500,000 to even a couple $1 million. And our budgets and our cash flow model assume a very small,
60,000.
but yeah, 60,000, which is nothing amount of those funds coming in.
But you can't claim them.
Yeah, it's one-time revenue that the timing is, it's a crapshoot,
And
right?
we have no control over it.
So the logic is that those users are coming in, they're paying to join the system, they're paying part of the overall capital cost that is already invested. And that's really money that should be going into the capital budgeting process rather than in the operational expense. Okay.
And we know there are several large developments that are worth mostly multifamily developments. We have no control of the timing, but we understand they're still moving ahead. Particularly because they're low income housing that have various sources of funding. Tax exempt, I mean, they don't have the same struggles that some of the commercial focused developers are having right now. So we expect those will happen, we just can't count on it. And that'll make that debt coverage ratio very quickly look
Yeah,
much nicer.
much prettier, yes.
Right,
If that happens.
but there's no guarantee that that will happen. I mean, we had this fiscal year, we had $800,000
Yeah,
loan that came in. We budgeted $60,000 for the whole year. This one was 800,000. Okay, the previous year, I think.
goose eggs, was goose eggs,
It was goose egg.
yeah.
And the year
There was
before that, it
nothing.
was, $1 million something.
Yeah.
Type of thing. So it's purely dependent on the one or two projects that come along. And then the projects have gotten bigger, but
And more
they
expensive.
aren't as consistent timing.
It's gonna be more infrequent now.
Yes.
Yeah.
Unless they,
Not much land left.
unless the biotech guys come back, but
For such a simple system like ours, it's actually quite complicated. All the revenue and planning, so.
Okay.
So why is the reserve for debt service not applicable in terms of the?
Yeah, that's a good
Priority.
question. So that's actually not outlined in the financial policy. However, we have a reserve account with our trustee for the 2016 bonds that is specifically used to pay debt service in June and December, that I separated out as this is only for debt service. So it's not included in our debt reserve, it's not included in our reserve policy, but because we do have to make that payment and we have an account that's specifically and restricted for that purpose, I've set aside that because it's a reserve or a restriction. It's more of a restriction. So,
And this updated financial management policy was actually just adopted last year.
last April, yes.
Yeah, so, as we move ahead, we're recognizing things that we'll want to update eventually. And that's probably something we'll do as an update, because we recognize it probably should be viewed differently than probably.
And really the reserve for debt service is determined by not our policy, but our official statement, like our trust agreement with the bank. So.
Okay. And going on, district engineer, Julie?
Kirk, I want to point out that you mentioned this was going to be a quick meeting.
Right, it's all your fault.
I was still, I was like,
I'll remember not to say anything.
I wanted to just, yeah. Okay, let's find some money.
At least 9, so.
So we worked really hard to get this bond and, we have to spend it, correctly and methodically. And so I listed out, I put in a little bit more detail because of, we have 2 new board members. I wanted to give some background on some of the projects. Typically, we just kind of jump in and when we just give an update as far as what happened last month. But in this case, I provide a little bit more detail and also I included the capital the capital exhibits in the board packet for the new board members. The DL&O project, the Copeland, Lincoln, Newell, Oak Knoll, that's a water main replacement project on those streets. That's out to bid right now. So we had a pre-bid meeting yesterday. We had 7 interested bidders. So that's a really good turnout. So hopefully we'll get some competitive bids coming in. We're gonna come back to the board on we're gonna come to the board on April 24th with recommendations to award, hopefully, if the numbers all work out and we have good bidders. And then construction would start somewhere in the June, July timeframe, depending on we're coordinating with the contractor and so forth. So we're somewhat encouraged with the turnout on that project. The other projects that are in design at various stages, the West Belmont Exborn Hallmark tanks, tank improvements. So those are tank rehabilitation projects for West Belmont and Exborn. Hallmark is a seismic upgrade and rehabilitation of the coating. So that's a packaged project. There was 3 separate projects. Typically, we list each tank as a separate CIP project, and then we try to combine it to get economy of scale when we go out to bid. So this is one of those projects that we'll bid out all together. And that's gonna happen. We want to do tank projects, or we try to do tank projects during the winter time, because that's when the fire demand on the fire danger is lowest, obviously, in the district. So we're targeting this coming winter for those projects. So they're all in design and I described. Unfortunately, with the Hallmark tanks, they're older and we couldn't find in our records record drawings for the tanks. So we actually have to have the structural engineer go in and look at all the components and measure and make sure that what they're designing meets the current code. Feel free to jump in if you have any questions.
The
Stay around.
tank projects, it's like $2 million, $3 million for the.
For West Belmont, I have to go back to, yeah, it's about 15 pages up on the packet. But
So Exborn is about 700,000, Hallmark's the big one at almost 3.2, this is including the escalation, and West Belmont's a little one at 130,000, so.
Yeah, I was trying to remember it from the capital list.
yeah, that's,
Hallmark's the big
yeah.
one.
so, we talk about volatility, we talk about one of the biggest concerns that I have with tank projects is they use up a lot of steel. And, right now, steel imports are, depending on what day of the week it is, they may be, tariffed, they may not be tariffed. Tariffed. I guess is what I would say. And so, we have a project out to bid for another water district, Westboro Water District, right up in South San Francisco. It's a tank rehabilitation project, very similar to this. So we'll get some bid prices here in the next couple of weeks. And we'll see, we'll adjust the numbers here as we get bids in. But the volatility, contractors do not like volatility. I think we were talking about that before the board started, the meeting started. And anytime there's volatility, prices go up. State Route 101 project, that's a project that's coming off the shelf. It was about at the 95% design phase. This is putting a new water main underneath 101 in the area of the PAMP hospital. We did a phase 1 where we put the water main in going to 101 from industrial. So along and there's an exhibit on later on in the pages. But we put phase 1 in, and then this is phase 2, which is actually tunneling underneath 101 and then going up on Shoreway, right in front of the BFI
or, not BFI,
Recology.
Recology now, but BFI was a long time ago. So, yeah,
Brown Ferris Industries.
yeah, I lived, I went to high school, here off of 41st and that's when it was called BFI. So,
BFI.
long time ago,
Wow.
aging myself. And then going up on Shoalway, from there. So this is a high priority project for us because we have a existing crossing on 101 that is pretty old and really susceptible to seismic, a breakage during a seismic event. So we do not want to take out 101 after an earthquake, due to a water leak and flooding or creating a sinkhole,
Yeah.
undermining 101. So that project is coming off the shelf and we're just starting it back up, meeting with the consultant that designed it and city of San Carlos and all the stakeholders, PAMP and so forth. So the other really critical project that is coming off the shelf again is the Coven tanks. That is about a 90% design there. And unfortunately, in that case, well, the background in that is two really old tanks. We're tearing down both tanks and then reconstructing both of them. We looked at rehabbing it, but it didn't make sense to rehabilitate. It would cost more to rehabilitate than tear it down and rebuild them. So we're going from a 1.7 million gallons to about 1.6 million gallons, just slight decrease in capacity, but getting a much more resilient two tanks right next to each other. So this project was 100% design, went out to bid during our last bond measure. And the bids that we got at that time, we only got two bidders at that time for this project because it was a very hot market. The bids came in about 25% higher than the engineer's estimate. So the board and the district staff came to the board and recommended we reject those bids, and it was shelved. Unfortunately, during that time, the structural engineer of record went out of business. So we can't go out to bid on a project like this without having a structural engineer of record. So now we're working with a new structural engineer and bringing them on board and having them review the project and then enough to feel comfortable being the structural engineer of record. And then lastly, is the transmission main assessment project. We did an assessment of, we have two ways water comes into the district. We did an assessment of one of those, which is up in the Hallmark area, the tunnels. And then now we're doing the second one, which is at Hillcrest, coming in from Redwood City up in the kind of the flat area. So we're gonna, and the way this works is it's a pretty neat system. They put a device inside the pipe and it swims along and looks at the pipe integrity from the inside using electromagnetic waves and other gadgets and stuff. And gives us a really nice report as far as the integrity of that pipe. These are two really critical pipes and we want to make sure that they're in good condition. And the tunnels one was actually in, I'd say somewhat surprisingly, really good condition. So that's good. I also listed a couple of city projects there. One is the city sewer project that we coordinated and gave comments back. And then the other one is the Twin Pines Park Detention Basin project where the city wants to install a detention basin, a storm drain detention basin in their parking lot in their city hall. And it's right in the middle of, we have a water main that goes right down smack dab in the middle of that parking lot. So we're trying to work with them on that project. It was a bit of a surprise a few months ago when they dropped that on us. So each CIP has its own exhibit and there's a CIP report and each CIP has its own exhibit. And on the right-hand side of each of those exhibits, it talks about the background, improvements, the proposed improvements, the benefits, and then the budget. So each one of these exhibits is meant to be a standalone document giving the background for each project. So it's always a great reference to go back and look at those when we talk about projects. So moving forward, I'm not going to give as much background on each project. I'll just kind of talk about what happened during the last month. But for this meeting, I wanted to give a full background on each project. So we have 91
think 90-ish projects identified. So, as Director Wheeler said, there's not gonna be a shortage of work. If we have the money, there's always a projects to prioritize projects to design and build, so.
The trick is that in order to produce a construction project, we have to have a year or more for the design and planning phases. So it's not like they're all on the shelf.
No, none of them, yeah, yes, exactly. It takes ramping up. You know, from the time we identify the project to the time that it's shovel ready. It's about a 11 month.
Right.
Process at best. At best. Any questions I can answer at this point?
So the 101 crossing project, I noticed we don't have a schedule for that, but we're still projected to do that in the next couple of years, yeah?
I hope so, yes, yes. So it's design is pretty far along. It just came off the shelf, so we're hoping that it can go pretty quickly. So the biggest thing on that was getting the tunnel underneath 101 design to Caltrans standards. We don't have a Caltrans permit, but our designer when they were designing it, had coordinated everything with Caltrans at that time. So we're hoping that it's a pretty straightforward process. There's a big sewer line that was put in on Shoreway. This goes to the treatment plant. And so we were waiting for that project to be done before we started our project, so.
Do you know what year Hallmark tanks were constructed?
1960, let's see,
68.
68? Yeah, I think it's in one of those, oh, I didn't include that exhibit. Yeah, but in the late 60s.
So, so the Coven is older than Hallmark.
Yeah, they're 52.
And you said that we don't have the plans for Hallmark?
It's not unusual to not have plans for tanks. And the reason is, the way tanks are built, they're design built. So basically, the contractor provides the design of the steel tank. And a lot of times, unfortunately, because it's not a set of plans that goes out to bid, the agencies don't retain the shop drawings for the tanks themselves. So what has been standard practice for this district and other districts that we represent is the as-built at the end of the project. Now for tank projects, we actually put the shop drawings as part of those as-built, so they'll be forever preserved moving forward. So they're not two separate documents, it's one document. So it's not surprisingly, unfortunately, that we don't have the drawings for.
We found some information, but they weren't any plan.
There were civil drawings, but, so they showed the footprint, they showed the foundation, they showed the piping, but not the steel tank
The shop
itself.
drawings themselves, yeah.
Yeah.
Because I know it's not as old as some of our.
Yeah.
tanks,
But it wasn't, the way tanks are built, they're, again, it's a design, so we say we want an 800,000 gallon tank, and then the contractor comes in with the design of the steel tank itself. And then the structural engineer checks it, so it's like I said, it's more of a design build or shop drawing process. They do get lost. I've seen more lost shop drawings for tanks than actual I've been able to find.
Right.
So,
Well, usually the shop drawings are fairly minimal. There's a lot of duplicate pieces. and-
yeah, it's very repetitive, yeah,
Right.
boilerplate.
Hallmark's welded steel tank?
All of our, yeah, I would, all of our tanks are welded steel.
Okay. Yeah.
So that's the reason Hallmark is being rehabilitated, because it's a newer tank. And then the Coben, because it's an older tank, we have to tear it down because of that 15-year, 16-year gap. Hallmark is in a much better shape, so we can actually do a seismic retrofit rather than a full tear down and reconstruction.
But those are huge.
Pardon me?
Those are huge tanks, so they're gonna cost us a lot more.
Both are really large tanks. Yeah, both Hallmark and the Coben tanks. The Cobens are tall, Hallmarks are pancake.
Thank you.
So,
Right.
right.
Hallmark are the largest tanks we have, right?
2.5 million each.
Yeah, yeah, so combined, that's 5 million gallons versus DeKalb is about 1.6 once it's all said and done. Any questions I can answer?
No, I'm good.
Thank you.
Also, that's good. Thank you. Now we're moving on to administrative services.
So the packet is in front of you. The biggest thing that I have worked on is we decided to do the operations manager brochure in-house. And that is the product that you're seeing in front of you. And it will go live and out next week. So I've listed all of the websites that the job posting will be posted for, as well as some of the mailings and where we're going to be sending it to. So far, I have just been doing word of mouth campaign, and I have had my first inquiry last night. And I have 2 phone calls scheduled for next week. So people are already interested in the position without it even being posted as of yet. So when it is posted, I will be connecting with all of you so that you could also be spreading the word out to everybody. But this is the brochure that will be mailed out to all of the Public Works departments and HR departments within San Mateo County, Santa Clara County, as well as East Bay. And then just kind of continuing on to the records retention at Folger. We're now down to 51 boxes out of the 60, and I think my fun surprise of the month was finding Vice President Bella's original interview packet. 1999, it was fun to read. I got to see your resume and everything, very impressed.
1999.
I wasn't there. That's not me.
Yes, it was you.
Unbelievable. You found this one?
I found all of it.
It'll be in the papers next week, Lois.
Oh, my Lord.
But it's always fun to see what I find, so I will definitely be sharing all the fun things with
That's
you.
fun, and do a good job.
Okay, moving on to operations.
Yeah, I'll just make mention of one thing, because it's getting late, but under administration on page 106. The very first entry there, Shane Headley is one of our newer operators. He's been with us a little over a year. And he recently passed his D3 water certification exam. So the D3 is in the middle, right? There's a D1, which is kind of the entry level operator. And then there's a D5, and that's typically somebody high executive in a water system. Our water system only requires a D3 certificate from the state of California to operate. But what I wanted to point out here is now with Shane's D3, we have 5 D3 operators. We've never had 5 D3 operators that I'm aware of. Just a few years ago, when we had a lot of D3 operators, we had 4. So anyways, it just shows the quality of the employees that we hired. I think last month I mentioned that Eric Perez obtained his D3. So we've got Shane, Eric, Michael Anderson, Ryan Gomes, and Destin Swift are D3 operators. That's pretty good.
Yeah.
Yeah, we're proud of that.
I'm just amazed at how many are working so hard towards various certifications and, they told me they're not gonna stop until they get, D3, T3 and
Yeah,
there's
training certificate.
so many going for the cross connection, specialist requirement, which is a new requirement for us. And I think we have a luxury that we're gonna have so many operators certified that way that I think, the other districts and cities will be very envious. Because they're scrambling and looking at hiring consultants to kind of fill the gaps, and so we just have a really great team right now.
Fantastic.
Yeah. But any questions that any of the board members might have with this information, typical or normal information to share?
Yeah.
The only thing that I wanted to add on this letter here is that I was not appointed on that, by the way. I had to run the election.
Not selected.
David Alter wanted No, there was about 5 of us, but David also was chosen there. But
And,
memories.
and general managers report.
All right, so, there's not a write-up on it, because I just attended it yesterday, but I went to the Aqua Legislative Symposium in Sacramento, which was not the most positive event that I've ever been to. Kind of my two major takeaways is at the state level, they're really struggling and looking ahead at the budget, knowing the likelihood that federal funds we're used to getting are likely going to disappear, looking at how they're gonna backfill those needs. One of the biggest concerns that Aqua was very aware of and doing advocacy and talking to folks is we just passed this wonderful Proposition 4 last year, the water bond. That money is supposed to be new money, new projects, new things. But with the budget needs, legislators are doing their thing and they're looking at, well, maybe we can spin it and fill an old need with it, as opposed to it really being, pushing us forward. More maintaining the status quo. So it remains to be seen, what comes of that. We're looking and thinking about ways we could potentially apply for those funds as the funding mechanisms come out. One thing we're thinking about is looking at, our CIP projects. And, I'd like to see if we can package up, call it our fire resiliency program, looking specifically at our intertype projects and some of our main upsizing projects, and see if we can frame it that way and see if there's an ability for the Prop 4 funds or even, legislative appropriations, and go that route and try to plan more strategically ahead of time to get those funds rather than right when we need them, because that's too late for just these processes to follow. So trying to figure that out in a very strange time. The other thing that was major takeaway and a big discussion was, so we're at the point where the legislators have just submitted all of their bills, and there's like something like 2,500 bills.
Wow.
Across the, two houses that everyone's, pulling their hair out, trying to review and analyze. And so many of them are related to wildfire and fire preparedness. Not too surprisingly. So, I was trying to read through this, but they're concerned about some of them because they are, they obviously have very good intention, but they're not necessarily well informed what those requirements are. So it'll be something to really watch and something for Aqua to really advocate, and, we'll be looking to us as agencies, and I'm sure CSD and the others will be involved too. But looking for us as agencies to support and help educate the legislators to guide them in a direction that's really appropriate and is going to achieve the intent. And not just put a lot of, onerous requirements on the agencies that can't meet. Another thing that was brought up, with all this focus and all the work with wildfires, the public, they look for a boogeyman. And we've seen in the media a lot, in particular the water departments down in LA were, put on the spot and, in many ways blamed for the, destruction that happened, even though no water system in the world is built to fight a fire like that. Maybe San Francisco, because they are built to, after the result of the San Francisco, and they have all these cisterns and stuff, right? But that's a very unique system. No other urban system is built like that. And so, the fire departments have all these legal protections and immunities against, so they can't be held accountable. Water agencies, we don't have similar protections. So that's definitely a discussion that's up there. So, it's something to pay attention to participate in the advocacy as we have the opportunity to, and hopefully it all goes in a productive direction. That will benefit everyone.
Wow.
Another thing, not on here, but I'm working with iParametrics at the federal level. Schiff and Padilla are requesting or have put out their call for requests for appropriations. I think it's a slim chance we could get any of those funds, but we're scrambling to submit letters because they're due like on Monday. They don't give you much time. So I might be reaching out to the Kirk, see if I can get a signature or two for me tomorrow.
Okay.
As we put these letters together, or Monday. But we're throwing our hat in the ring and we'll see, how those go. More kind of positive. Last week, Retta and I had a meeting with Jim Yoke from San Mateo Consolidated Fire Department. So he is an emergency planner, not a firefighter himself, but he's been in emergency planning for about 25 years now. And he is tasked with updating the emergency plans for each of the cities that that fire department serves, which is Washington City, San Mateo, and Belmont. And it was a really good, really productive conversation. He said, well, you know, we shared with him a lot of the ideas we had. We actually had a brainstorming session shortly after the LA fires where, you know, Brenna and I and Michael and the lead operators, we all sat down and we kind of said, okay, if, you know, we had, you know, a magic wand, what are the things that you would want the fire department to do to help us help them? You know, what are the requests that we could make of them or things we could do for them? What would that look like? And so we actually had, you know, a very specific list of kind of actionable items. And so we brought these up to Jim. And he said, these are all very reasonable, they make a lot of sense, common sense, but he had never thought of them himself. He had never encountered them in all of his other coordination with other agencies. So we kind of opened his eyes. He said, I'm not going to sleep tonight. It's very clear we have a lot of work to do. Oh my God, but I'm excited, but oh my God, you know, it was one of those, sorry for blowing your mind, but great. So I'm excited because he seems very committed to updating his plans and working with us and doing things right, and perhaps even in a kind of a more of a leadership way that other, you know, could be even a template for other agencies and other areas. So that was good. Before that meeting, I had a meeting with Supervisor David Canapa. He's the president of the supervisors this year. Shared with him similar thoughts on fire planning. He said, oh, you should talk to, I'm gonna mess up her name, I want to say Sachi, with County OES wants to set up that meeting. So that again, we can share these thoughts and again, more regionally, hopefully, see some of these things implemented. And we had such a good conversation. It was really productive. He's interested in just learning more about us, talked about some of our projects, like the 101 project, as well as the EOC and Dairy Lane. So he's actually planning to come tour, we're narrowing down the time right now, but he's planning to come tour the district and meet us April 15th. So, I don't know, President Wheeler, if you're around or
I should be.
if you're interested, a couple folks who wanna meet with him, I'll let you know when we get the time set. We'll have them out to Dairy Lane and we'll have the posters on our Folger property and we'll just spend some more time with them, so. That's the plan, and just kind of keep these relationships building. The other things in here, there's more kind of legislative advocacy. I just kind of give you a summary on some letters that we've signed on to and are helping support. And everything else is kind of standard, but let me know if you have any questions on anything. I'm happy to go over it.
You mentioned that Jim from San Mateo. Can you cite maybe one or two examples of things that you came up with that he didn't think of?
Well, there were several. One is just, and this was part of, you know, June's discussion and request is, what if we sit down with the fire department and we kind of identify a few scenarios, kind of realistic scenarios that could happen with wildfires or larger urban fire, you know, bigger than your normal ones, you know, structure fire. And let's model our system's response, figure out how much water would be available, what pressures it for what time periods, and share that information. And what he didn't realize, and actually I only became recently aware of too, is that in 2020, there was a wildfire in San Juan Canyon. And as I understand it, it came very close to losing homes, neighborhoods.
And that was mentioned at the.
Yeah.
The EOC.
That's where I learned,
Uh-huh.
and that it
I mean,
was, you know,
we
kind
all
of a
remember, I
Minutes
saw the
away.
fire, you know,
minutes
from my
away,
house, it was right there.
that they got lucky, the winds shifted.
Correct, yeah,
And CAL FIRE came through with a big dump from Water Dog Lake,
yeah,
and
yeah.
if those two things hadn't happened, we would have had our own. You know, wild urban interface disaster, so. And it's where, from what I understand, even during that fire, they didn't reach out to us, they didn't coordinate. So one thing is, hey, every time there's any fire, dispatch should give us a call. That way our on-call operator can be right on SCADA, watching things, involved, seeing, is there an opportunity to move water? Can we start filling tanks in the area?
Yeah.
Because it takes time to fill tanks, and any single small structure fire could get out of hand, you don't know.
Yeah. of
So
course,
let's
yeah,
be
yeah.
proactive.
Yeah.
But we can't be proactive if they don't call us. So that's a simple thing. The modeling is a simple thing. I mean, you know, it's effort, but it's a very actionable, easy thing we can do.
Also being notified of like red flag days ahead of
Mhm.
time, so we could pre-fill our tanks, right?
Yeah.
And those,
Yeah,
because those events are, you know, a few days, they get noticed a few days ahead, right? The high fire
yeah,
danger
but the
days.
city of Belmont should also be aware themselves that, for example, Water Dog Lake during the fire season should never be below its normal level, which it sometimes it is, you know, because that's right below me, and I go for a walk and I go like, in the summer, why is the water so low? You can't even pull water out of it.
Well, and I wanna have a conversation with them. This is something I don't know. I mean, we obviously have Crystal Springs nearby. And I assume they can pull water from there. I'm pretty sure that they
Oh, they
can.
could, but Water
it's
Dog Lake
farther
is right
away.
there, you know?
Yeah. But it's farther away.
Correct.
And, you know, I don't know, is that distance meaningful in time wise for their fire response, or would they have a benefit from something closer? If so, there is something called a heli hydrant, has a couple different names, but there's a device that you actually can put out in the field, put in the high fire, you know, risk areas, that's hooked up to a water system. We flip a switch, it fills, it's non-potable as it's sitting there, but helicopters can take a load from that heli hydrant.
Mhm.
They have these in Southern California and more rural areas that aren't close to reservoirs, so, you know, hey, if that would be a benefit, let's know, we can, and we could probably hopefully find some funds, some FEMA funds, something, who knows, but, you know, that's something that we could do, but we
You
need
have
to
pre-fill
coordinate with them,
days.
we need to know it's valuable.
Yeah.
And we don't. So there's that, there's some ideas regarding workforce, since our workforce is so spread out, if there's a major earthquake and, you know, there's just no traffic flow and people can't go, well, what if we identify us and all the other agencies in the area where our licensed, you know, certified operators live? And before there's an emergency, we, you know, learn, you know, who lives in or really close to our system. Let's do some cross training, some shadow days, so they can, you know, get familiar with us and our system. And if there's a major response and people can't move, well, they can come work in our system, our folks can work on the system where they live. But that's obviously a big regional coordination effort, but,
Yeah,
you know, it's something that wouldn't really cost anything other than, you know, a
Some
few days of
handouts.
shadow days and training, so.
Mhm.
And could potentially have a very meaningful, real benefit, so. There's some ideas, I think there were a couple more, but.
yeah,
Who controls the levels at Water Dog?
was there,
Water Dog Reservoir, who controls
I think the city does,
City of Belmont?
they maintain it, you know, so I'm assuming that the water level is up to them.
I never looked at it to see what sort of a discharge control we might have.
Yeah, it's not the best, but it's too small, you know, but in the case of the San Juan Canyon fire, it just
Yeah,
didn't
that's
trip. And even San Juan, that area, I don't know if you're familiar with that area, but it got congested right away with traffic.
Yeah, they're only,
You know, with the fire equipment coming in and people trying to get out, it had just all the elements of a disaster. And we
Right,
just lucked out, on that one.
there are a lot of neighborhoods that. Gee, there's one way in and one way out.
Yeah,
sort of
yeah,
thing.
especially on those Belmont hills there on here.
In the hills.
But I mean, flames, I think, I remember, the flames were shooting at least 60 feet up in the air.
Wow.
I could see from my house, I could see, because my former house is right there on Montserrat, And going, oh no, not that house. But yeah, but flames were just shooting up.
So, okay. So we are supposed to be trying to schedule a strategic plan meeting coming up, or?
Yes, we are, and of course, we have one director, or two directors not currently here, so.
So we need to-
Once we get everyone in the room, we'll figure out a good day that's gonna work, and that, Julie Brown, our facilitator, will be
we can
available.
do a little message, calendar, poll or something like that.
Yeah,
Okay,
that one.
thank you.
Thank you.
So 9B directors reports. Louis, you have?
We had a very good, and I'm sure you guys will talk about it too, a very good meeting with, at the HIA meeting. That was the ferry service, right?
Yes.
From the city. It was amazing that the people that I used to work with at the Port of Redwood City when I was with the fire department are still there. So I talked to the speaker afterwards, and I mentioned like 3 out of 5, and they're still the same people.
Wow.
But that was, hopefully it will come to fruition here, because
It's hard to tell.
it could take quite a load from the traffic.
Yeah. But the problem is always with those types of services that you have to have a concentration of jobs that people want to go to at one end and vice versa.
Yeah. Well,
But they were
Redwood City-
talking about connecting San Francisco to Redwood City.
Yeah.
And Oakland to Redwood City. So. Yeah. I mean, there are a lot of people taking Google buses to come down from San Francisco and.
Correct. Yeah, but there are a
But there are a
ton
lot
of people
of-
going from the peninsula up to San Francisco every day,
True,
so.
but I'm not sure how many of them would be advantaged by going to the port to get on the ferry. And taking extra time to get to San Francisco versus taking Caltrain. Type of thing.
Yeah,
But if Caltrain's getting busy, then people, living in high density housing in Santa Carlos could. Go to Redwood City to the port, get to San Francisco that way.
it depends on how much the cost is going to be too.
True,
They haven't. Unless it's a subsidized cost, it's not gonna work, as far as money goes. But anyway, but it was a good presentation that you made.
Yeah.
And then we had the finance committee meeting, which, we talked about these bonds, so that was it.
did you do anything related to the district outside?
I have no report
Okay,
to provide to the board, but I do have a request, which is I would also love a tour of the water district. So if it works with my schedule, I'd like to tag along on April 15th on Supervisor.
Yeah, that would be great. I don't think usually they don't give a lot of time for these kinds of visits, so I think we're just gonna stay at Dairy Lane. Absolutely welcome to join. And you don't have any report, we did have lunch Friday.
Well, I had a great lunch at that. Filled me in,
memorable.
with full. That's right, I could do something related to the district, thank you, Karen. I'm excited.
Good late.
I had a good sleep.
Good late.
Getting late, yeah. Yeah.
And the other thing I wanted to mention is something we'd like to kind of start doing once a year. I don't think a little organization, but doing kind of an board member open house event, probably, even renting a van, figuring out a good day and going and actually visiting a couple of our facility, so a couple of tank sites, a couple of pump stations, and just kind of sharing, and, we can kind of rotate around the district each year, but I think that would be,
Yeah, it would be.
fun to see.
We have, many people are invited to go to the Hetch Hetchy tour, once or twice a year. I mean, we could do a small one, for our district too.
Once construction projects start, we always invite board members to come up
Yeah.
and watch the construction also. And see how pipes are placed and
Yeah.
and stuff. So that's another.
So you're saying with the tank projects, they can come watch the paint dry?
Tank projects, but the pipes are always interesting, right? It goes underground, you never see it.
And they have big equipment that moves it around and digs
Yeah.
holes.
Paint dries.
The tank ones aren't, when they demolish it, that's pretty neat.
Yeah, that's kind of neat.
Yeah.
Well, actually, the little robots they got to do welding. those are
Yeah,
fun
it's-
stuff.
it's-
I'm bringing feelings.
Yeah.
Right.
Well, I'm available to do all those kind of things so that I can have something for my direct report.
So I went to the HIA meeting and the finance and found it. So that was interesting. Okay. And now, we have no communication.
No, we do not.
Okay, well, I think we can adjourn. Thank you all. And it was all my fault.
I didn't say that, Rena said that.